home.
we have to be, but others
The
don't have to
you
be.
could run a bowling ball through the control room. Everybody's work from home.
But Google actually says that working in the office factors into performance reviews. And I love that Zoom. I mean, we talked about this yesterday, but that's just
Back
the
to
key.
work.
Get back to the office. Don't Zoom your way into
Factor
Zoom.
it into remuneration if you care that much.
One
We
of my-
talk about company culture. I don't either.
One of my top advisors here is Marty Schenker.
Yeah.
When he gets on Zoom, Staten Island dims. He's got that.
Does he go on
he
Zoom?
has
Does
like
he?
35 people on a Zoom call.
Very cool.
It's amazing. It's like Hollywood Squares.
Okay. You don't use Zoom, do you?
Never
Yeah,
has.
are we still on? Are we still here?
We're still on air,
We're
Tom.
very under surveillance.
We're still on air.
Want to talk about Apple?
We're not going to black.
I want to squeeze this story in. ESPN signing an agreement with casino operator Penn Entertainment,
Yes,
a deal
please,
worth
please.
more than $1.5 billion over 10 years. Penn will launch the ESPN Bet brand in the US, with a casino operator selling the Barstool Sports brand backed by the founder, Dave Portnoy. So Portnoy gets it back after selling gear. Wait for this, for more than $550 million back in 2020. So Portnoy's like just absolutely crushed it here. Just crushed it. Now, there is a deal that if there is some kind of monetization event down the road, that Penn's going to get a lot of money out of that deal if Portnoy goes in that direction. But it's amazing how this story's developed. Effectively, essentially, the Walt Disney Company doesn't like brand Barstool, doesn't want to be associated with it. So once you get wind of that, if you're Dave Portnoy, I mean, you're just sitting there and you know you've got them over a barrel, right?
It's like, I'll just walk away. You don't have to do anything.
You don't have to buy it back. They just give it back to you.
Yeah. Oh,
because they
thanks.
want to seal the deal with ESPN and Disney.
And now it's going to be Dave Portnoy unleashed.
Good for him. What a turnaround, Tom. Selling that for $550 million a few years ago and then getting it back for free.
Is a fossil, John. I don't even know what Barstool Sports is, but John, what you can describe it. But what it reminds me of is how I feel about gaming, betting, and that it's all come here. And like Microsoft, Activision, it's a world I don't know, except people I respect say the cash flows are just frightening.
It's happening quickly.
Yeah.
Yeah.
We're just going to move on to bonds, and we do that with Mark Cabana. He is one of our favorites here at Bloomberg Surveillance, head of U.S. rate strategy at Bank of America. And the hallmark here is he writes with clarity and avoids BS. And so you lead your note with one of the all-time jargon words of the moment, resilience. Everybody out there, the Boston Red Sox are showing resilience. What a bunch of baloney. Translate your use of resilience to the real world of fixed income.
Well, I think it's a generous characterization of the Red Sox right
that's
now. But what we mean by this is that the economy has really shown that it has been relatively insensitive to higher interest rates so far. We all thought that we would see the unemployment rate tick higher. We thought we would see fixed investment drop by more. We thought we would see financial conditions tighten more substantially as a result of all of the rate hikes that have been delivered so far and that are expected either in the future or that are expected to remain elevated for a while. And what we have seen is that the economy is really held in. And that has challenged at least some perceptions at B of A about how much we would expect to see the economy turn. Our economists just last week changed their base case from a recession to a soft landing. Now, that's a maybe minor distinction, but nonetheless, it implies less of an upward pressure in the unemployment rate. It implies an economy that can continue to grow for longer, and it implies that the Fed is going to probably have to adjust accordingly. And the way that we think that that adjustment takes place is not necessarily through a higher overall terminal rate, but for a Fed that does indeed remain higher for longer and by cutting slower than the market anticipates. Certainly higher for longer can mean that you hold the terminal rate for an extended period of time, or it can mean that you maybe cut once a quarter, which is now our economist base case, as opposed to the almost every meeting rate cut that the market is anticipating once it gets started.
So would you push back against the people, one after another, who've come on this show and said, we're buying long-term bonds because we think it's great to lock in 4% yields? It's going down to 3.25% or 3.5% on the 10-year.
So we're still reasonably constructive on duration. We do recommend that clients trade the back end of the rates curve with a tactical long bias. You got to respect the range, which looks and tends to be around 375 to 425 now. And we think that because we just believe that long end rates look somewhat asymmetrically skewed to the downside. It's a lot more difficult for us to envision 10s at 5 than it is 10s at 3. And with a Fed that's cutting slower, you're not going to maybe see as as significant of a bond market rally. You're not going to see as rapid of a yield decline, but we still think that yields will be moving lower in time as the Fed does indeed move to cuts, but just cutting slower perhaps than the market anticipates.
I want to just ask about the consequences of holding rates at this level for a longer period of time. Are people adequately understanding how restrictive that becomes as growth slows and as companies have to start refinancing?
Yeah, it's a great question. I heard your comment earlier about credit and Torsten Slok and what he is saying about underlying fundamentals there. Look, we do think that the credit markets are going to be okay if the Fed ultimately delivers on what's priced for cuts in the forwards, because as you have a lot of maturities that come due, the Fed will be lowering rates, and that's going to soften the blow to some extent. The challenge will be if the Fed does indeed remain higher for longer, and if you start to see some of those refinancings occur at higher rates and see companies begin to adjust how they're going to manage that cost factor into their own calculus. But it's a part of what I think the Fed is looking for. They need to slow the economy somewhat, and they need to ensure that inflation does indeed remain around 2. In our economists' new profile for growth, they do think that inflation just falls slower, understandably, right? You're going to be averaging 2.8% next year, almost 2 to 2.5% in 2025, and the Fed's going to have to move rates slower, allow for more restrictive monetary policy over time in order to ensure that that sticks.
We're tight on time, but the question's too important. Can price give way as yield moves higher? If I look at the Bloomberg Total Return Index, I got a pennant formation. I'm really on support right now. Can price break through that, price down, yield up?
Well, what we think you need to see is that you need to see some type of economic driver for that. We know that supply demand in the Treasury market is really quite daunting right now. You had a surprise from the U.S. Treasury on supply last week. The number one question that we get right now is who's going to buy the bonds? And so what you really need to see is that you need to see the economy provide cover for investors to justify that long duration bias that we've been recommending, that they appear to be holding, especially on the real money side. Thus far, you haven't really had it yet. CPI tomorrow should hopefully move us in that direction, but you really need to see signs of broader economic moderation. And right now, the growth data is not providing that because the economy continues to reaccelerate.
CPI tomorrow morning. Mark, this was good. As always, Mark Urbano, thank you, sir, of Bank of America. If you're just tuning in, welcome to the program. The S&P 500 positive here by a 0.2%. Coming up shortly, 8:30 Eastern Time, Kathy Bosjancic of Nationwide Mutual Insurance. That conversation just around the corner. Tom, going into that inflation data tomorrow and some PPI data going into the weekend on Friday.
To dovetail Cabana into Bosjancic, John, Atlanta GDP now. I'm not a big fan of the series, but there it is. Are you ready? 4.1%. I didn't frame it. I didn't guess it. I'm looking at the Bloomberg screen at a 4.12%. Whatever the calculation is of Atlanta Fed, that's a boom economy, as Mr. Cabana just alluded to.
They back off prematurely. There is a risk that the next few months looks like a soft landing. Their rhetoric, and you can already hear this when you listen to them, that they start to back away and they start to embrace the prospect of a soft landing, which risks, Lisa, a loosening of financial conditions and, to Mark's point, a reacceleration in the economy and reigniting inflation risk all over again.
And you're seeing that actually getting priced into the market. And I'm seeing this increasingly in the break-even rates that we're seeing going forward, whether it's the U.S. or Europe, rising to the highest levels going back to 2008. And this raises a question, okay, are these accurately pricing in people's expectations for inflation over the next 5 to 10 years? Or is this just a reflection of oil prices going up and rice prices going up and basically tracking the commodity cycle? So, these are some of the things people are thinking about when they're trying to determine their long-term call in a sleepy Wednesday.
Big dose of the latter. Big dose of the latter. That the commodity market's feeding some of this. But certainly the reacceleration in economies is also feeding some of this as well.
Absolutely.
I say economies loosely because I'm talking really just exclusively about America and the United States. Kona Hack of ED and F-Man is coming up shortly from New York City. Good morning.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when I got to 100, I'm a man of my word, I got a tattoo.
DOJ or other authorities
could face bigger challenges.
So was elected.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
It'd be okay, is getting ready to make a decision.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I'm not a person who pre-declares where I think rates ought to go. I just let the data tell me. We have time before the next meeting and the meeting after that, and the meeting after that, to figure out whether the various forecasts of where the economy is going come true.
The next meeting on September 20th, that was Tom Barkin there, the Richmond Fed president. Before we get to the 20th, we have some inflation data tomorrow morning. The next inflation print after that is September 13th. In between those two prints, one final payrolls report that comes in early September. Tom, going into the Fed decision just around the corner. And just around the corner is an inflation report which should show, predicted to show on Wall Street, further signs of disinflation.
That's the bet right now.
There'll be some base effects in the mix which push headline year over year a little bit higher potentially, but ultimately looking for further progress going into September. From there is a little bit more unknown. Do we get a reacceleration in inflation? Cities say yes, others say no.
And looking at core, taking out oil and gas and the rest of it and the other trimming and all that. The breakup here is going to be interesting. I fall back like everybody else to the gossip. What are used cars doing? And all this stuff. And, food, frankly. I hear there's chicken disinflation. There's pork disinflation. I mean, it's out there. You were mentioning Tyson's the other day.
Yeah,
mentioning disinflation.
The deflation has actually hurt their bottom line. That's the flip side.
And that's a story,
Value
right?
add.
That's a story right now in
Chicken
commodities.
Stock's been butchered.
Sorry, that was just terrible.
It's worse because it's the second time I've made that joke this year.
But it's pretty good.
Hey, this week.
But whatever. Same thing.
Different audience.
It's an August audience. Thank you for tuning in on radio and television. This is an important conversation and goes to the heritage of what the world did out of World War II. Out of World War II, there was real worry about food. It was starvation in war-torn Europe. It was starvation in the third world. It wasn't funny. There was some luck in science, in getting better science, better seed technology, and all of that leadership came out of the World Food Program. It was one of the things the United Nations did right, starting in 1961 with the support of the United States and other countries in Rome, Italy. Our next guest lived this, Kona Hake. Joins us right now, head of research at ED&F. Man, I think a lot of people don't know that, Kona, that Rome is ground zero for food economics, food science. What was it like growing up wrapped around the World Food Program in Rome, Italy?
Well, number one, Rome is the most extraordinary place to be living, and being raised there was an experience like no other. But you're right, United Nations Food and Agriculture Organization or World Food Program, or even IFAD, International Fund for Agricultural Development, it all seems to be based in Rome, and they are transformational in terms of the work they do, not just on economics, fundamental research, but also in policy development and helping the poor, getting the food to where it's needed the most.
We see a leg up in rice now what does it mean? And I've asked this with respect, just I don't mean to pick on Cambodia, but that's always a country I've used where you have a 70% food budget among the people. What does this leg up in rice mean for the countries like Cambodia?
Pretty intense, pretty acute actually. We're now at the rice prices globally are at the highest they've been since 2008. So this is no mean feat. And it stems from the ban out of India on some of the key rice exports, lower yields out of Thailand because of drought. So the fact that rice is the major staple for at least half the world's population, Cambodia included, means that a lot of people's disposable income is going to be suddenly spent on something that's becoming treble of what they used to pay for. So yeah, pretty extraordinary.
Are the
very tight conditions.
Are the disruptions that we're seeing, whether it's rice or we saw the disruption in wheat as well, although to a lesser degree, are they long-term events? Do they have staying power, or is this sort of a one-off that will require some sort of action by a number of nations that have rice that can produce it?
So I would say the first part of the question, rice, it's not too many countries that can produce rice. And the fact of the matter is most of the Southeast Asian countries that produce rice are all seeing some kind of yield decline. So I think that's not going to be an easy fix. On the grain side, however, we do have multiple. So yes, although Black Sea right now is under a lot of geopolitical tensions because of the Black Sea being blocked or under huge military threat, there are other sources, for example, the USA, Europe, Canada, who can provide alternative grains. And that's one reason why today's wheat prices are not as elevated as they were pre the Ukraine invasion, whereas rice prices have just gone skyrocketing.
So rice is sort of its own story in a different kind of way. On a broader level, I noticed that European natural gas is jumping right now. We're talking about gasoline prices that have been rising in the U.S. We talk about oil prices, which are bumping up past that $80 a barrel, at least traded on the WTI NYMEX. I'm curious from your vantage point whether you see this continuing, that the disinflation in commodities that we saw 6 months ago has reversed.
Yeah, that was our call actually, that in the second half of the year, we were going to see commodities make a bit of a revival. The premise for this was because we saw the dollar weakening in the second half, purely because US interest rates were going to have peaked by then. So we're seeing a bit of that, money coming back into commodities. But the big kick was really OPEC Plus getting together and substantially making cutbacks. That has fundamentally altered the S&Ds for oil, crude oil, and I think we now know that oil fundamentals are fundamentally going to have to require higher prices, and $80 to me feels like a fair price considering how tight things are. The only caveat, I suppose, is China, the disinflation story you were talking about. I think that's a worrying signal, but the bulls out there will think that this is exactly what is needed to require the stimulus in China, which will then ultimately allow some more demand push for some of these key commodities. Metals in particular is one that has would really be massively boosted if China were to stimulate.
Kona, what's your base case for stimulus out of China? What are you expecting?
Well, I've been really surprised how piecemeal their action's been so far. I think they're worried about maybe their financials in some of the key states in China. I think something's going to have to be done because this level of low export-import and disinflationary trends are not sustainable in the long term. They have to do something to improve purchasing power and confidence. So I feel that something's going to have to happen. It's not just going to be through the rates. There's probably going to have to be more fiscal stimulus, but honestly, I've been surprised how slow they have been in this, and that makes me worried that they're not heavily invested in active stimulus, but at the same time, they have no choice. They have to do something.
Hasn't happened yet. Kona, thank you. Kona Hack there of ED&F Man out of London on the latest in the commodity market. Tom, I think if we didn't have budget deficits the size we have here, if we didn't have unemployment as low as it is here, if we didn't have the kind of GDP figures that you referenced just moments ago, we'd be so much more worried about what's developing in China over the last few months.
Totally agree.
And we're somewhat insulated to it in America, which means the conversation is just so different over here.
How much do we spend on food at home of our budget? We spend 5.6%, just under 6%. Food away from home, and this includes Farrell, the way you live downtown, we spend 5.6%. We spend about 11.3%. We spend 11.3% of our budget. Downtown is under 59th Street. It's a broad, broad swath. But the bottom line here is we spend 11, 12% on food, okay? When we're talking to Conahague, we're talking about nations where they spend 60, 70, almost 80% of their livelihood on rice. And we are, to your point on China, we're totally removed from this.
So the politics that goes with that, Tom? What happens next in some of these countries?
Politics is the World Food Program. Right now, it is Senator McCain's widow, Cindy McCain, I believe it is. I'm sorry, mental block there. But Mrs. McCain is leading the U.S. charge in Rome at the World Food Program, and it's something that we've been looking. I did a lot on this years ago when rice went up, and all of a sudden I had to be a rice expert, where a lot of smart people told me I was wrong with my American stereotypes.
And then it also raises questions for businesses that are operating in those countries. I think about what happened in Italy, and they kind of tried to reverse course a little bit, I guess, dampen what they did yesterday. But cost of living crisis, costs are going up.
I'm glad you bring this up.
Tax the banks and give them the money. I mean, it's sort of like there's...
Back away a little bit.
John, one day they're backing away, right?
Yeah, just, less than 0.1% of the revenues or something like that, profits.
What's that?
Is that any way to run a country?
Oh, brutal.
No, I mean, we're worse. I mean,
Taking shots at Italy today.
I'm not taking shots at Italy.
Sounded like one.
Where should I go next in Italy? I'm supposed to go to Umbria.
We'd like to go.
Away. COVID got in the way.
Umbria, yeah.
Umbria. I was supposed to go to Umbria.
Okay.
How about Bari? That's down in the heel.
That's in Puglia.
Down by the Prada logo.
Daryl Cronk of Wells Fargo joining us next. I might not be here. This is Bloomberg.
You'll be on one of the 3 islands you live on.
Of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you would be.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is not a market for easy money.
The U.S. economy has been resilient. It has proven surprise to the upside over and over again.
I think the economy probably is able to muddle through.
You haven't fulfilled even the 3% pullback yet.
Risk scenarios are that the Fed overstays its welcome here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, 24 hours, 30 minutes away from the only thing that matters this week, the disinflation report of the United States of America. Off of China deflation, John Farrow, do we just assume American disinflation?
Most people are, Tom. Citi's Veronica Clark saying that it's unlikely to challenge the building narrative of a soft landing until later this year. So for now, this sweet spot we've talked about where the data looks pretty good, output is strong, GDP is resilient, and inflation shows signs of coming down. Risk assets perform. Then what? Does the Fed back away? Does it keep rates on hold, allow real rates to climb? For how long, TK? That's going to be the story for the back end of this year into 2024.
There's 18 flavors to measure it. What I do is 90 days, 3-month annualized. That's just one way to do it, not the best way, not the worst way. I wonder how Jerome Powell analyzes this as he goes from a 9-minute to a 7-minute speech in Jackson Hole.
If he does speak in Jackson Hole, what can he say in Jackson Hole? Can he really draw any firm conclusions, Bramo, around the data we've seen so far, particularly going into the meeting at the end of September, given we still have another CPI print after this one ahead of him? I think we've had a teaser this week from various Fed officials. If you look at the core of the Fed and you go to the New York Fed President John Williams speaking to Bloomberg, speaking to the New York Times earlier this week, speaks to Bloomberg too, don't worry about that. Speaking to the New York Times earlier this week, he made the point, and I think it's an important one to make, it's highly intuitive. As inflation comes down and nominal rates are on hold, real rates increase, and we'll have to do something about that next year. The problem that they're going to have, if they start having that conversation too early, too prematurely, financial conditions start to ease, growth is supported, and inflation can reaccelerate again. That's the risk you're always running. So this is still a pretty fine tightrope to walk.
And you've said, what is the upside for Jay Powell coming out and actually having any conviction whatsoever, any thesis whatsoever on what to do forward? I gotta say, this should be a sleepy August where we're not going to get data that's going to be conclusive, where Fed officials aren't going to give us any kind of guide forward. But it's not. And I feel like more and more guests are coming into the office. I feel like we're seeing this sort of groundswell of concern, to your point, Tom, at a time when are we due for a narrative shift? I mean, it's been a couple weeks.
John, I would say, I just did this, and I'm not going to do a banner or a chart on TV because it's August. It's too much work. John, you take the pandemic trend of inflation in America, and we've rolled over on core CPI, and we are exactly at 2 standard deviations negative. So this is the reading where if we get further disinflation, you break out of that core statistical study, and someone like Daryl Cronk can go, we have disinflation.
We've made progress. Is it too early to declare victory? We've certainly made progress. You've made progress in the labour market as well.
Nice political illusion.
Job openings down. The quits rate has come in. Tom, we've seen payrolls decrease, deceleration there too, but unemployment's still 3.5%. And that's still 100 basis points south of where they thought it would be. Only 6 months ago, looking out to the end of the year.
And Crocs whispering in my ear, Tom, you got to go to logs to do this correctly. We're almost there. Maybe tomorrow we'll see 2 standard deviations of disinflation. We're not there. Let me save myself with a data check. John, how about the real yield, 1.66%? In-betweeny is what I would call that.
Equities right now firmer by 1/3 of 1% on the S&P. I remember when Tom and I first started doing this show together, and it just felt like I was talking to myself for 2 hours.
Got that right.
It still feels the same.
They brought me in.
Nothing's changed.
So you could share my pain, Bremo.
Right here for you.
Lisa, the 10-year, 4.0262%. Tom, the euro, slightly stronger, 109.73. Crude,
it's great.
$83 a barrel.
The Tang is slightly stronger today as well. Joining us right now,
kidding.
the adult in the room, Daryl Cronk, with decades of experience at Wells Fargo as their CIO. It's wonderful to have you here. Seriously, I took a big fancy chart and I went to logs on the y-axis, blah, blah, blah. And what it means is the vector of disinflation in place in America. Is it?
It has been, but I'm gonna take the contrarian side of that. I think the second half of the year, inflation ticks higher. I think we finished the year probably closer to 4% on headline CPI than we do 3%.
What about core?
Right? Core probably flat lines here, around 4.5, 4.7. So, Thursday's reading will be probably 3.3, a tick up. It'll be the first time headline inflation goes up in a full year, right? It goes from 3 to 3.3 on year over year. And core probably comes in around 4.7, still way too high for the Fed. The problem is in the back half of the year, you lose the comps, right? So you've got, in other words, you need oil prices to be $70 in the back half of the year just to keep CPI flat, right? You already have gasoline prices going higher, as we know. Rents are actually starting to trough and tick higher, right? We still have way too hot of wages, right? So I think the surprise the market's not priced for, and this is why you're starting to see, to Lisa's point, people are coming to the office, they're getting nervous, right? We just printed a 9-month high on the 10-year. Right? You're getting real yields drifting higher. You're getting the 5-year forwards drifting higher, right? Everybody's looking at that. It's causing pressure on your long duration equities. You lost 3 of the 7, magnificent 7, technically, that are all now below their 20-day, right? And the NASDAQ sitting right on top of its 50-day. If you lose the 50-day, there's a lot of blue sky below it.
It's going to sound brutal, but nervous about their jobs or nervous about markets?
More nervous about markets, candidly.
Okay.
I think we're overextended here on markets. I mean, look, if you look at
that sounds mean. It wasn't meant to.
You were just
if you look at the data, I mean, all of this has been sentiment, right? No question, the sentiment's gotten better. Everybody's improved on sentiment, but the data is not telling the same thing. If you break down even the subcomponents of the leading indicators, the leading subcomponents are still drifting lower, right? So if you just if you woke up from a 2-year slumber and you handed me a package of charts and I started looking at them, I would say, we're kind of on the precipice of probably a tough second half of the year, and you're heading into August, September, October, which is kind of, as we call it, murderer's row for seasonals, right?
It's even more brutal.
Yeah, it is.
Do you want to go sit over by Lisa?
I think so.
Tom made the point on Friday, and I think it was a really good one, that it was the first payrolls report that felt a little bit like a payrolls report pre-pandemic. Is that what's happening here? I saw delinquency rates yesterday coming from the New York Fed. They had some credit card data. And you go through it all, and it says delinquency rates are back to where they were in 2019. Is this just an economy still normalizing back to what we were before the pandemic?
Yes, normalizing, and that's exactly right, but normalizing in an entirely different environment. Normalizing at a 5.25% Fed funds, right? Normalizing in, I sent you guys a chart. If you look at just commercial loans and consumer loans and credit conditions, they are as tight today, right? Tightening on a relative basis on a change as they were in 08, 09, 2000, 2001, and even the pandemic, which actually credit conditions would suggest on commercial and consumer that you're back in an area where the real conversation is soft versus hard landing, not soft versus just no recession at all. So look, I know that's a non-consensus view, right? Everybody comes in here and says the world has turned, it's great. Atlanta GDP now says 4.12%, GDP for third quarter. But remember, that's off of the budget deficit data that came in yesterday, right? That pushed that number hard, right? If you get inside of it and look, what really happened is imports slowed, which tells you demand is slowing, right? So you need to really get in the data and understand it.
So when you talk about people going back to the office, more than you would expect during an August where most people would be going on vacation, what are they worried about? What are they looking for? A technical breakdown just because things are not really factoring in inflation remaining higher for longer? Or is it they're worried about accidents as credit conditions tighten, as people start to see lending tighten on every level?
Yeah, I think in our office, people have their head on a swivel looking for where does that accident come from, right? Because invariably you tend to get it in that tightening cycle. Probably comes, your most robust candidates are going to be your highest leverage candidates, right? It's going to be perhaps a private credit market manager, perhaps an emerging market, right? Something that triggers this. We thought maybe, you saw the Fitch downgrade last week that everybody got a little excited about, right? But it's kind of worked its way through. So I think people are worried most, Lisa, about rates, right? And where rates go from here. Because as you have, I don't know if you saw the data, we now have the Treasury market at $25 trillion. We've got to put away $11.7 trillion of issuance in the back half of the year, right? Which is almost half the entire Treasury market, right? That we've got to roll and put away. So all of that's going to put a continued upward pressure on rates, we think, here in the near term. And when the 10-year is above 4%, it's been, in this cycle anyway, breakage points for equities.
So where's the haven?
It's a good question. I think you got to play a little defense right now, right? So if
what does that mean?
Well, so you stay on the short side of the curve on the fixed income side, right? It's not time to fully buy all duration yet. Credit to us looks overpriced, right? We've been favorable all year on large cap over small. That trade's hurt us the last 2 months, but it's been there all year. We actually took down our mid-year outlook. We took tech down to, we were favorable on it coming basically multi-years into this and downgraded it. I think you look at healthcare, materials, and probably a combination of energy and industrials. All have greater earnings contribution today than their market cap, which is not true of discretionary and technology. So you look where you're going to get the best earnings protection relative to valuation, right? And those to us make sense right now.
Daryl, this was fun. Kinda. Daryl Kronk of Wells Fargo. Slightly depressing at the same time, but deeply thoughtful. Appreciate it, as always. Lisa, there's some important stuff in there about how the back half of this year develops. Can you really take the data through the summer and extrapolate it out through the next 12 months? I think most people would just tell you that's extremely risky.
That's what Citigroup is saying. It's the same kind of message, basically, that the year-over-year comps make it likely to see a resurgence in inflation later this year, which could cause some more hiccups. I'm just trying to understand where you park your cash. Is it just cash? Is it the bond stock kind of, 60-40? People saying maybe, lead into duration. Other people saying not so much. And to me, that's the big thing.
Long end 4%, Tom?
Well, yeah, I think that what Lisa just said is really, really important. Park your cash is something from over the last 15 years. Right now, you park your cash, you're making a living. And,
it depends on how much cash you're making.
You're making a real yield. But, we've had outflows from the triple leverage all cash fund. But can you imagine if we get the BTMM screen to break through to new high yields in the short-term space? How many people are looking for that? I think very few.
True. If you are just tuning in, welcome to the program. The S&P 500 here.
Plug in there nice, huh?
Positive by 0.25%. Joining us in about 20 minutes' time, we'll catch up with Kathy Borchansett of Nationwide Insurance. TK, I hear you. It's an important conversation. If you have a couple of mil to tuck away into cash there, you can make a living.
Well, that's what institutions do. But the answer is, we haven't had this conversation for 15 years. Daryl Kronk and I were in our ute. And the answer is we're now back to, okay, it's valuable and I'm getting 2x the dividend. Why not park some in cash and wait? There's a lot of people taking their fear of missing out and shifting it over to, maybe not.
Lisa wants to talk about Novo Nordisk.
I totally do. That's exactly where I wanted to go.
I know you did.
This is the thing, is that in this market that's totally not correlated, you get these stories, AI, and now it's like weight loss drugs, and all of a sudden the injection providers are getting their stocks bid up, and Novo Nordisk.
The team on the London desk are talking about the prospect that Novo Nordisk becomes the biggest company in Europe and takes over LVMH.
Well, if this is actually safe and people can take this injection and then lose a ton of weight, then it could replace. I'm not looking at you. I'm just saying that if you could, theoretically, it would have a pretty big
yesterday.
Thank you. Marketable tool.
A weighty move yesterday.
Oh my God, you're really on a roll.
I'm just bored. What was annoying to me is that we had this rally off the back of data. They'd done some kind of test or something.
I know where you're going with this one.
It said apparently it drops the risk of heart failure and heart attacks and heart disease and strokes and all of that. Yeah, obviously.
You lose weight, and that is a normal
Isn't that just the sequence of things? Did we need someone to tell us that yesterday?
I mean, that's, I think, yes,
Yeah.
raising questions around.
I promise I'll call the doctor about it. N-O-V-O space N-O-R.
Oh, dear Lord.
Yes, dear. I'll call
What's
them.
theirs?
Novo Nordisk.
Wegovy? Is that it? Wegovy? What is it?
I don't know, Ozempic?
Is that theirs too? Is that
No,
someone
no,
else's?
that's someone else's.
That's someone
That was
else's.
just like a bleed on.
Okay.
You're both looking at me.
I'm pleased we were
We're
prepared
not.
for this segment. Well done, Lisa.
I tried.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think the Fed has the power to get inflation back to 2%. It's just a matter of whether they're going to do what they need to do, and are they prepared to take whatever pain that brings with it. I'm a little more worried about 2024. I mean, my base case is that we do kind of muddle through, but I think if we're going to get a recession, I've always felt it was more likely in 2024 than this year.
Stephen Stanley of Santander on the inflation data. Plenty of debate, plenty of views going into the numbers themselves. We'll get the numbers tomorrow morning. Tom, got that countdown clock ready to go? 24 hours and about 13 minutes away until that inflation data, TK.
The countdown clock is valid here because I'm sorry, not only is it the data of the week, but I'm sorry it has supremacy almost over the jobs report. I've never said that in a million years.
Oh, for this Federal Reserve?
Yeah,
Sure,
I mean, it's a dual mandate. Inflation. Okay, core inflation as well. That's a dual mandate.
And then you look through the labor market and you connect it with
wages and, I get
inflation.
that.
Yeah,
But,
that's the story.
I mean, Daryl Cronk was great. He said, look, wage inflation, it's not come down. Am I right?
Yeah, well, it's come down, but at a slower pace. My issue is, at a certain point, is it really going to matter? Because we're going to get a data point, and it's either going to be high or low, and then people are going to say it doesn't matter because it's going to totally be different, or it's going to be a head fake, and that's basically what we're hearing everybody kind of gear up for right now.
There's a new bias. 12 months ago, it was tell me why I shouldn't hike. 12 months later, it's tell me why I should. That's a new bias on the committee.
That's nicely said.
Thank you.
You can write this
Can I leave?
7-minute speech at Jackson Hole. We're going to get to this. This is too important. It's a 2-hour conversation with Michael Nathanson, senior research analyst, Moffett Nathanson, expert on Disney. Michael, I'm going to go back a few years to the summer of 2003, where you were a young buck analyst, and you were forced to watch Finding Nemo, Pirates of the Caribbean, Bringing Down the House, and Freaky Friday, all back to back. Disney was riding high. It was a double-digit layup, and it's been the mother of all disappointments. What does Iger do today? and in the next 90 days to right the ship?
Tom, he has a long checklist of things he has to fix, right? He has to, your content pipeline that you spoke of, it's broken. It will not be 90 days and better. He has to work on trying to figure out why have they misfired so much on the film side. Maybe changing some leadership there. He has to work on getting ESPN some new partners, as you talked about, maybe finding a partner to invest in ESPN and potentially getting that off his books. He needs to then figure out what to do with his cable networks. Maybe he needs to sell those as well. And he has to work with Comcast to buy in the Hulu 33% stake that is coming to him next year. And he has to worry about DeSantis in Florida. His checklist is enormous, right? So he has a very busy 90 days ahead of him and probably in the next 2 years to fix what he has to fix.
Might be easier to frame the question the following way. What isn't for sale, Michael?
Right. What isn't for sale, John, is the parks, right? Like, I think what's happening here is that the parks are taking over leadership of this company. And as long as the U.S. economy does not weaken materially, the park story should hold pretty well. And our thinking is that this company's in transition from what Tom described as an IP-led company to a parks-led company, right, with streaming attached to it. So I think we're in the beginning of a real transition of Disney's assets into a more targeted company.
Michael, I ask, how long is this going to take? Because there's a leadership question embedded in that. How long will this take?
It'll take the next 2 years, and that's why he's been re-extended, right? They need to make some very tough decisions, which he's hinted about. Our point is, like, look, we've been negative about linear networks since we started talking to him. The weakness is apparent. It's here. He wants to get those businesses off his books. It's not going to be easy. It's not going to be very accretive to do that. But he needs to get those off his books. He needs to change leadership, in the content side, to fix streaming. It's going to take time. It really is.
When you talk about some of the units for sale, I wonder how the deal that was announced yesterday with ESPN and Penn Entertainment factors into that. This idea that ESPN is going to be going into sports betting, which isn't completely congruent with the sort of family-friendly image that the rest of the parks kind of cater to. Do you think that this is sort of a predecessor to a spinoff?
I think it is. I think they decided the past 2 years that the U.S. perception on gambling had changed, and their perception had changed. This is a deal where ESPN gets $1.5 billion and some warrants, but I do think it's a predecessor to finding new partnerships and trying to reposition ESPN off of their books in partnerships with other companies, right? So, the ESPN's troubles, to me, are not easily fixed. But perhaps you can find some ancillary businesses like gambling, maybe e-commerce. You have to build a new streaming business for them. So I think you'll see ESPN, spinning off of, being spun off of Disney, maybe even taken private the next couple of years. So that could be done off stage somewhere.
When it comes to fixing the content issues on the streaming side, how much of the focus is going to be on artificial intelligence, creating content that is less dependent on some of the talent, the writers, the actors, et cetera, versus just streamlining everything and having a more targeted package and then selling off the rest?
Lisa, that's a really good question. I think in the near term, it's about streamlining. I think they would say, and he said this, that they've just made too much content. They've been stretched too thin at Marvel, Lucasfilm. Pixar has its own issues. But I think in the near term, it's trying to figure out the optimal set of content choices, trying to look at the leadership of some of these verticals. Longer term, the AI question is hanging over this entire industry. It's a potential risk, right? If all of a sudden the barriers to entry have dropped so much that your kids could start making Disney movies.
Michael, I got 8 ways to go here. 8 ways to go here. We could do a 2-hour conversation on this. We're thrilled you're with us. The bottom, I'm going to go financial. I got 60% plus debt at Paramount, 60% plus debt at Warner Brothers Discovery Disaster. I've got 30 plus debt at Fox, whatever. And Disney's debt less encumbered at 21% on the balance sheet. Is debt Iger's salvation to merge for scale?
It's a good question. I think I think his salvation is getting his cash flow. So, you know, Tom, they used to generate $10 billion of cash flow a few years ago. Now they generate about $4 billion of cash flow. I think his opportunity is really to focus you on the park business and fixing streaming. You know, Kirsten, to your point, because he owns parks, his balance sheet is not the same risk of the other companies you mentioned, right? Those balance sheets are going to be the story the next couple of years. I think Disney can work their way out of it by focusing on parks and fixing profitability on streaming. So to your point, you know, he has flexibility here, and I do think the story is if you look at the value of resort assets, where they move to, Disney stock is cheap if you think about it as a different type of company led by resorts and hotels and parks. That's what I think Bob's looking at the next couple of years.
Michael, I've got to squeeze this in. You're in the perfect seat to ask this question. It said in November 2022, everyone hates Facebook, Meta, and Mark Zuckerberg.
Yep.
It's now in the summer of 2023. Everyone loves Facebook, Meta, and still hates Mark Zuckerberg. Is there something that the Walt Disney Company can announce in the same way that Zuckerberg did in early November to talk about the year of efficiency to turn this name around more quickly?
Yes, and John, you remember I was on air with you guys defending Facebook and Meta the whole time, right?
Yeah. Well, you got 30 seconds to tell me now.
Yes, because the reality is their streaming businesses lose too much money. Netflix is worth $200 billion. Disney streaming businesses are worth $10 billion, right? The focus is in fixing profitability of streaming. You know, let parks continue, but fix streaming profitability, get those linear networks off your books, and people look at this and say, wow, this stock is really cheap. So we have a buy on Disney. I think next 12 months, we come back 12 months from now, the stock's higher from here because of what you said.
Michael, thank you, sir. It's what you said, not what I said. Michael, thank you. Michael Nathanson of SVB Moffett-Nathanson. The great call on Meta and what developed over the last, just amazing what's happened there over the last 9 months, right?
The degrees of freedom that Mr. Iger has is just about zero. I mean, I'd like,
spot.
You know, although I figured out Barbie, they just do it with Bambi.
Okay. Would you like me to say something back to that? Okay.
Barbie, Bambi.
I'll be stepping away now.
Slowly or quickly.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave In China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Bloomberg Surveillance, good morning, everyone. Lisa Bremas and Tom King. John Farrell on assignment, getting ready for the next hour here. We got the countdown clock going here. We're 24 hours and 15 seconds away from what matters. Lisa, did you know there's an inflation report tomorrow?
That's what I've heard. And I've heard it's going to be really important, a CPI report to talk about how much progress we've made and does this turn up the heat to raise the bar for the Fed to go again or just stay on hold, which seems to be the desire.
15 minutes for Global Wall Street to stay with us. We're going to go to Kathleen Bostjancic, all of her good work at Nationwide. But first, we get a briefing with Michael McKee. Michael, yesterday out on X, see how like I did that? There was a zeet from Jason Furman of Harvard University.
Man, you really adopted the
Jason Furman. Yeah, that's
language
my
here.
fever's down. It's under 103. I'm down back down to 101.
Might as well have some more tang.
We're going to have some more tang. Michael, he tore to shreds the math of Atlanta GDP now, 4.12%. Michael McKee, is it just a marketing series? It is just a thing that we really shouldn't pay attention to?
No, it is a thing to sort of track where we are, but it only tells you where we are at the moment. This is just the beginning of the second month of the quarter, so we're only getting data from the first month of the quarter, July, and we've only gotten a half of that or part of that, so the number is not going to be based on any kind of end of quarter reality. So you don't look at it's sort of like looking at a presidential election poll a year ahead of time. I mean, it's not going to tell you who's going to win because you don't even know who's going to be running. But we can say that the Atlanta Fed nailed it in the last quarter. Their final figure was 2.4. We got 2.4.
Well, we're looking right now at the potential for year-over-year comparative figures that are going to be easier to beat. And this is sort of the key question that I have. Do you buy arguments that we could see year-over-year disinflation now, but it could be reinflation later in the year as some of the comps become easier to beat?
Well, I think it's a little bit different. I would put it differently because we're not going to see probably disinflation now because we have such easy comparisons to last year. Last year there was zero inflation. Inflation was measured at zero on a month-over-month basis in July of last year. So any inflation is going to push the year-over-year number up, which is why we are anticipating a slight jump up to 3.2%, 3.3% for the month of July compared to 3% in June. But after that, we don't know for sure what the impact of energy prices is going to be on the headline. It is going to have an effect going into the next months. We'll see headline inflation go up, but everybody's going to be, I mean, the Fed is going to be focused on the core. And one of the things that we are looking at is instead of the year over year, you look at the month over month to see if progress continues to be made. And we've come down a lot from the 0.5, 0.4 numbers on a month-over-month basis to 0.2 last month. 0.2 is what's forecast for this month. The Fed would see that as progress.
Some people will say that in the housing market, which accounts for a significant portion of the CPI, you are seeing the cool down more broadly in rents, even though some people say you have seen a bottoming out, you haven't seen a reacceleration. How much in the housing sector, as well as in the auto price sector, some of the key features in the CPI report and in the core, how much does that seem to be stable? And in a stable way, staying fairly constant and not really rising?
Well, they're not rising anymore. They are falling, and that should be some good news overall and help push the core down some. Used car prices at the wholesale level, everybody looks at the Manheim auto auctions people data, they're down 11.6% on a year-over-year basis. So we're anticipating used cars will push down on it. Housing has been going down. It's been what everybody's been waiting for, but it's been very, very slow. And to get back to your earlier question, Lisa, because there's nothing for sale, home prices have gone up. And now, with what we've seen in the bond market over the last week, mortgage costs are way up again. So that'll take a year to get into the system, but it does present some inflation down the road.
Where I wanted to go. You and Kathleen Bust-Johnson are fancy people, and you're looking at 3-month annualized in 1 year and trim bean Dallas and all that. Our listeners and viewers, they don't look at it like that. To them, it's 2-year inflation or 4-year inflation. I've got the 8-quarter moving average of pandemic inflation, lofty. This is headline inflation, 6.6%, which I think feels to the angst of all the mail I get from our listeners and viewers. They seem almost unattached to you and Bust-Johnson about what price change is doing.
Well, we're sitting here talking about whether prices are going up or down in a month and whether they went up 0.2%. The average person is going to the grocery store or to the department store and saying, these prices are higher than they were a year ago.
Or 2 years ago.
And when we talk about disinflation, we're talking about the rate of inflation going down. We're not talking about people actually cutting prices. I mean, it'd be nice if we did, but people are not cutting prices. So people are looking at what it used to be, because they haven't gone back to school shopping since last summer. So now they look at what school clothes cost. I'm sure Lisa's doing that. And they're saying, you know, we've got inflation.
I'm going to suggest for President Biden and President Trump, 6.6% 2-year headline inflation is the emotion that's out there. We'll have all that data and the excellence of Michael McKee for you tomorrow at 8:30. Right now, Kathleen Bust-Johnson joins us, Chief Economist at Nationwide Mutual. Kathy, am I right that the public here doesn't really care about all this micro data analysis? They're looking at the 1 year, the 2 year, the 3 year pandemic inflation, and it's killing them.
Well, good morning, Tom. Happy to be with you, Lisa and Mike this morning. I think that weighs on the Federal Reserve, not just weighs on consumers, but it is something in the back of all the Fed officials, mind when they think about inflation. Yes, they're looking at the most recent print and they're doing the 3-month annualized, 6-month annualized, but they know that this inflation is really a tax on consumers, especially lower income and middle income households. So, Chairman Powell wants to make sure that, when he looks back and his legacy is assessed, he's not seen as leaving with high inflation. He missed, right? The Fed thought it would be transitory. You don't really want to leave and move on and still have high inflation, as you end your tenure there.
Kathy, are you in the camp who believes that this CPI report will be really important in order to determine whether the Fed hikes or stays put? Or are you in the camp that probably it will not give us a whole lot of information? It might even be a head fake for reinflation that we see later this year.
Yeah, so timing is always difficult. I think for now we are in a disinflationary trend, and I do think tomorrow's report and the subsequent report after that will be important as the Fed convenes in September to decide whether to keep raise rates again or to be on hold. But you're right, when you look out, the problem is there's quite a long lag. So when you look at home prices, they lead the rental inflation by about 1.5 years in our modeling. So yes, eventually it could start to turn back up, but it's a long time before that. But yeah, we are concerned about that. What I'm also concerned about is the fact you were talking about this earlier with GDP growth. We seem to be accelerating, right? 2% Q1, 2.4 Q2, and now, at least 3%. We're not quite at the 4% the Atlanta Fed, as Mike rightly said. That's kind of a snapshot of current data. But the economy accelerating, or certainly not slowing below potential, what the Fed wants, I think it's tougher to bring down inflation.
from an economic perspective, we were talking about wage inflation with respect particularly to the union organization and what we saw with UPS and some of the wages. John wants to get a $170,000 job driving a truck, as he informed us this morning. Does that factor into your estimates of wage inflation, of the dynamic of how much you could get an acceleration in the economy as wages continue to increase? Is that something that you're looking more closely at as you do hear more of these organized labor discussions?
Yeah, I'm concerned. I'm concerned that not that wage growth is the strong wage growth is causing inflation, but that it's a barrier to lower inflation. Now, certainly, it's great for workers to get their share of the income pie, but it comes at a time where we have these inflation pressures. And again, it's just a barrier to lowering it. So I think it makes it more difficult, keeps the Fed more in a hawkish tone or mood, and may even lead them to raise rates further.
Kathy, well, away from rent and housing, that's what we talked to, particularly in New York. We're really focused on it 24/7. What's food inflation doing? What's auto inflation doing?
Yeah, so food inflation has come down quite nicely since the peak, especially right after the outbreak of the Ukraine-Russia war. And that's encouraging. Now, there's still concerns, right, if there's some kind of blockade and what happens with wheat prices. And just in general, there's still, I think, a fragility and uncertainty about if there could be disruptions. But in general, food inflation, we should be key, as Mike said earlier, inflation's slowing, but we're not seeing outright declines. Now, the auto sector is different. We are seeing used car prices outright decline, and that's welcome news for consumers and also for inflation measures. But how far that goes is key. We may see some outright declines, but we're still seeing a supply-demand imbalance in the auto sector, meaning auto companies, when they do produce and supply comes online, we're seeing demand exactly match that. So I think there's still upward pressure, again, resistance in the auto sector, right, especially for new autos.
Remind us as we end this, Kathleen Bostjancic, the inflation series that matters to Chairman Powell. Which is it?
So it is core inflation, and I would say it's super core inflation. So that's core inflation less the rent. And the reason being that rental inflation, even when we model that, should come down very sharp. We think it goes from 8% at the peak to about 5% by year end. But that is baked in. They want to see what's happening to service prices elsewhere, outside of rental inflation.
Great brief. Kathy Bostjancic, thank you so much here. We're 24 hours away from this incredibly important report. Lisa, what stuck out to you there? I mean, what was the thing that mattered to you there?
Just the difficulty in gaming out the various elements of inflation. Housing in particular is the real mystery to me. I've seen some reports saying that rents continue to come down, and the rent equivalent owners inflation metric that they use for the CPI is a little bit strange and lags. But at this point, you also do see rents reaccelerating. This, to me, is a very tricky moment.
It's a tricky moment. The Economist had their Carrie Bradshaw index this week. They published it 40 cities, and it's the median wage. Their serious index, median wage compared to a studio apartment. And there's sort of 20 cities in the game, a bunch of people, a little elevated, and then there's New York. It's like a moonshot of unaffordability. Right now, Standard & Poor's 500 up 0.2%.
What really caught my attention was Roblox, because everyone's
explain this. I do know it, but I don't. Help me.
So basically, it's a platform for, I don't really understand it either because I've never actually spent time on it, but different games that are all loosely affiliated with the same platform, and they can program your own. You can program your own games, or you can play on other people's, and it's interactive. The shares are lower by 8.3% because people are spending fewer hours. The hours engaged were 14 billion. Versus the estimate of 14.4
that was just
billion.
At the Bramah House.
I know, exactly. I mean, I've looked at this and I've got to be honest, and no offense to them, but I was like, wow. I mean, it's not the worst thing in the world that people are using it less.
And I'm deficient on this. You know why? I won't let the machines in the house. It's the one thing I put my foot down on.
What about the phones?
The phones I have, it's a disaster.
They're on the
and
phones,
all of it.
but it's all on the phones.
The we, and Joe Coy talks about we, and I don't have any, I'm ignorant.
The Wii is like an exercise routine, though, where you can do tennis or whatever else.
Plays with his mother.
Yeah, but all I know is that this sort of question of what is the correct usage for some of these companies in the post-pandemic reality, when people don't have literally 14 screens in front of them to try to take their mind off the fact that they have nowhere to go.
I got like 6 books going right now, and one of them is a cricket book by Satya Nadella. It's really, really quite good. Are games addictive? Is Activision Blizzard's, is this addiction like cigars or whatever?
Well, China thinks so. China thinks that even the iPhone is addictive, or just smartphones in general. Did you see they're like limiting the use of kids to use it? And I think there's going to be a lot of really interesting.
I thought it was a spin-off of Clorox. Good morning, everyone. This is Bloomberg Surveillance.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
We are seeing, that the effects of, let's say, Bidenomics or, all the initiatives that the Biden administration has undertaken, those effects are still filtering through. They probably will continue to filter through. We think inflation is going to come down. It's going to come down meaningfully. Services spending is still strong, but it has decelerated. If you look at food services, if you look at recreation services, those are the things that the Fed is looking at.
What we do is speak to authorities on these statistics that matter. Rubila Faruqi there with High Frequency Economics, as we just spoke with Kathleen Moschanczyk of Nationwide on this important inflation series tomorrow. I should say Michael McKee, of course, will go beneath the headline data at 8:30. There's a singular headline out, which is of your certain vintage. The word normalization speaks so much. This is from the Wall Street Journal moments ago. The United States and the Kingdom of Saudi Arabia agree to broad terms for Israel normalization. This story is breaking right now. We'll have much more on this. For perspective on this, I can't say enough about Francine Lacroix's effort with Mr. Netanyahu in the recent days. It is hugely controversial, and there's no other way to put it, but Francine Lacroix with a primer with Benjamin Netanyahu on Israel, on domestic affairs, on the judicial system. But Lisa, to see the simple headline here, there'll be much more on this. To go back to my memory of the 67 war in all of the history we've all lived, an extraordinary single headline of agreement between the United States and the Saudis.
Especially at a time when a lot of people had expected a ratcheting up in tensions between Israel and Saudi Arabia, with Saudi Arabia being critical of some of the recent moves over in Israel, Israel trying to at least Netanyahu trying to put forward some sort of ratcheting back of what they were talking about in terms of reforming or changing the court system and making it a little bit less independent was the fear.
Oh, there's the headline there from the Journal, and we'll move on from that right now. One of the things that we've been talking about, Lisa, and I've been hugely remiss on this, is to get clarity on commercial real estate. There seem to be generalizations out there by people that aren't experts, and the fact is that maybe we should speak to somebody that actually, heaven forbid, knows what they're talking about. And we'll have to see on that. But to me, the heart of the matter is CRE. And do you just look at the office trauma of work from home, or is there more going on than just work from home? To me, that's the arch question.
And is it just isolated to the office space sector? There was a story in the Wall Street Journal over the past couple of days talking about how buildings, rental buildings, single family, like multifamily housing units, actually are seeing huge declines in valuations right now. And this is tied in part to the story of work from home. If there are people who don't want to live in city centers, but there also is this question of, is there something else going on? Every person who I've talked to say, well, there's a distinction. You've got, for example, the warehouse space and other space that actually is holding up its value quite considerably. But it feels like there's something going on when you look at mortgage rates of 7.4%.
I look at the mortgage rate question, and to me, it's a 30-year discussion. And of course, we all know about where fixed rates are now. And somebody got one. John Farrell's apoplectic about this. People with a 1% mortgage. But the bottom line for me is a commercial real estate redo, the refi, the recommitment is a 5 or 7 year timeline. I'm speaking as an amateur. It's a much shorter timeline where I think the optimism here is it gets solved quicker. Joining us right now, Alexander Goldfarb with Piper Sandler. Thrilled he could join us today on CRE. Alexander, I want you to speak of the stereotype of the moment that's wrong. What upsets you most about the analysis in the media of CRE?
Well, first, thank you for having me on this morning, and appreciate it. I'd say what is most troubling about commercial real estate, and certainly we've been writing about it at Piper Sandler for quite a while, is people will make broad generalizations and they won't really dig beneath the surface. So they'll make a blanket statement, sort of drop the mic, walk away. And I'll give you two analogies.
Please.
Years ago, people said the mall is dead. And they would go and they'd show some derelict mall in some, small market or some, tertiary place that had, long since ceased being relevant. And then the same at Christmas time, they'd show up at like the Westchester, right, or Roosevelt Field, which are Simon assets, and show all the kids and all the families coming out to meet Santa. And it was like, wait a minute, what's going on? Same thing happens today with office. Everyone says office is dead, office is no more. And yet, if you look and say, wow, SL Green sold a 50% stake in 245 Park Avenue, and everyone is blown away and amazed that people are interested in office. And again, this is the same thing. So people need to look between real estate and figure out what is legitimate, desirable real estate and what is the stuff that is fading away.
Alexander, Lisa wants to talk to you about the realities out there for the people of our cities that seem to be flat on their back from CRE. I want to talk about the landlords. Do they have an adjusted internal rate of return? As the market clears, is it then business as usual, or is it a new territory for landlords of CRE?
So I'd say for CRE, the biggest change that's occurred over the past decade is one, people realizing that it's not just the market that wins, it's the product. So that's first. Second is that development is a lot riskier than people realize. And third, that the best laid plans, often go awry. So if you take it in that order, years ago, New York was the end-all be-all. Now people realize that the Sun Belt is an amazing spot to invest and make money in real estate. At the same time, people are realizing that you have to own the right assets. So you've had new people who go down to the Sun Belt and then are amazed that there's supply. Meanwhile, people who have invested in the Sun Belt for decades understand how to work around that supply. Same thing in the urban areas. People, as you know, in Manhattan, people paid big numbers for real estate and then get left holding the bag. Meanwhile, others have been successful for decades investing in Manhattan real estate, making a lot of money. So again, it's that market knowledge, and I think over the past decade, the REIT investors and the REITs themselves have really come to terms to better isolate and understand that dynamic in a way that didn't exist, 20, 30 years ago when REITs were really coming about out of the RTC days.
Is the money from China, is the money from Japan, is that drying up that used to come into the U.S. and buy commercial real estate?
So the money that came from China, everyone's making headlines because the Japanese this cycle. They think about the 80s, Rockefeller Center, Pebble Beach, et cetera. Well, the Chinese were the Japanese of this cycle. Right now, the Japanese look to be the smart money. They haven't invested really in the U.S. in decades, and they're coming in and sort of picking off at sort of low, post pandemic prices. The Chinese definitely, look at the prices that were paid even for, the stake in 245 Park, for the Waldorf. You can go down the list. The Chinese certainly paid top dollar. But again, a lot of overseas investors, it's really a reallocation trade, and that always can do wonky things. So like take Latin America and Miami. As we know, for decades, Latin America comes to Miami not because of value, but as a store of value. And unfortunately for the Chinese, they were pretty aggressive in coming to the U.S. looking for that store of value the last cycle, and we've all read the headlines of what's transpired.
Just real quickly here, do you think that people are overestimating or underestimating the pain that is likely to come down the pipe when it comes to commercial real estate?
So I think it's both. On one hand, if you look at what happened post So I think it's both. On one hand, if you look at what happened post the credit crisis, there was a lot of fear of peak CMBS that would overwhelm the system. It didn't happen. The condo loans worked out. There was Course Bank that got worked out, but most of those loans, got resolved. In fact, the big benchmark GG10, I doubt many people know what even happened to that CMBS issuance. So when you look at today's, and there are a lot of stories on it, when you look at that, yes, there will be loans that go back, keys that go back, because those buildings are not desirable and they're no economics, and it's not worthy of investing. On the flip side, you have what Vornado did recently, where they worked to restructure a loan on one of their high street retail assets. So again, if there's value in the asset and if the economics make sense, the lenders and the borrowers will work it out. If not, it will go back. But let's be clear, no bank wants to get the keys to a derelict asset, right? They have every reason to want to work with the borrower. And by the way, the special servicers, they make more money the longer the deal gets wrapped up and goes back and forth. So there's a vested interest in the special servicers to try and work it out with the borrowers as well.
Okay, we're out of time. Alexander Goldfarb, brilliant primer there on CRE. We don't do enough of this. He's with Piper Sandler this morning. I feel terrible about this because it's a huge part of what we do in economics, finance, investment, and we do CRE sort of as an afterthought. Right now, it's not an afterthought.
Especially given that Moody's thinks that this could actually lead to fundamental weakness at a whole slew of regional banks, as we heard yesterday.
Tomorrow, we've been waiting for this all week. The week begins tomorrow at 8:30 on Thursday with an inflation report. We hope you will attend. Michael McKee will be in to give us important perspective, always with the best guests we can find for you. This is Bloomberg Surveillance.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
In New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Live from New York City this morning. Good morning, good morning. Counting you down to the opening bell with your equity market slightly positive on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, equities bounce ahead of inflation data in America. More Fed officials beginning to embrace a soft landing as the president hits the road to promote Bidenomics. We begin with a big issue. It's CPI up next.
We're going to get a CPI report.
U.S. CPI data on Thursday.
Is the inflation rate bottoming this summer, and is it going to start up, or is the inflation rate going to continue to head lower?
We think that's going to be a softer report.
That will look softer again.
Inflation is softening.
A lot more subdued.
Moderating.
Moderating as we had expected.
As we've been anticipating.
The risk is the CPI report basically takes away a little bit of the disinflationary narrative.
I think that we're at the low on a year-over-year basis now.
There's a chance we're actually on the headline number, we're going to actually see a little bit of an increase.
The CPI report we are seeing this week will be very important.
That's what the Fed has said, that's what they're looking at.
They're trying to figure out what their next move is going to be.
It's all about inflation.
It comes down to inflation.
Tomorrow morning, 8:30 Eastern Time. Your preview starts now with JP Morgan's David Leibovitz, Patrick Frizzetti of Rose Advisors at Hightower. Let's get to you first, David. What are you and the team looking for tomorrow morning?
So, overall, we do think that the year-over-year figure may increase slightly relative to what we saw in June. A big part of that has to do with what's gone on with gasoline prices over the course of the month of July. But our general take here is that, inflation does continue to soften. I'm not sure that it's the immaculate disinflation that markets have been pricing in, but we do think that this will be a continuation of the broader trend that's been observed here over the course of the past few months.
Patrick, your view on the same thing?
I actually think, most analysts, as we know, they're expecting a little bit of an uptick. I certainly expect that. When I look at inflation, I look at some other things. Clearly, the energy backdrop is higher. I also look at some of these other indicators. One of my favorite indicators, to be quite honest, is the one the Economist came out with years ago, is the Big Mac Index. You're on the road with your kids and you stop for some fast food when they're screaming, and the price of the Big Mac is up, 30% over the last 3 years. So I'm looking at a lot of different indicators, and I don't expect it to necessarily be as disinflationary as many others think.
Is there the prospect it reaccelerates later this year, Patrick?
I do. I think so. With I expect a weakening dollar, but more importantly, I do see higher energy prices continuing to impact the disinflationary pressures that we see in some of the core areas of the economy. Certainly I understand the price of used cars, looking at the Manheim Index, that was down month over month again, year over year, that's down over 10%. But I see more inflation as we head into the back half of the year.
There seems to be a sweet spot between now and the back half of the year, David, where a lot of people, even if they think that, they still expect the data not to challenge the soft landing narrative. Veronica Clark over at Citi wrote that July CPI data this week is unlikely to challenge the building narrative of a soft landing. Is there any reason to believe whatsoever, David, that the incoming information between now and the rest of summer challenges this soft landing narrative?
So, I think that the inflation data we have a pretty good grasp on. I would agree with a lot of the things that were just said in terms of, could move higher into the end of the year at the headline level. Core is proving to be sticky. I think that is very much the elephant in the room. And the one thing that could disrupt that kind of immaculate disinflation and soft landing narrative would be core inflation that remains stickier than a lot of people currently expect. I think the other thing we need to pay attention to is what's happening more globally. The European economy is not in a great spot. We got some pretty downbeat numbers out of China overnight. It feels like economic activity is beginning to slow more significantly again at the global level. Whether or not the U.S. catches a cold is going to be a big question as we work our way through the next couple of months. But obviously, if that weakness abroad begins to feed into what's happening here, that's going to put this kind of soft landing narrative to bed because it's going to create some downside risk around the trajectory for growth.
Well, David, growth is bad, but disinflationary forces might be good. When you put it together, is the data out of China this week good or bad for China? Good or bad for the United States?
So I think the data out of China is not great for China. I think that the tailwind it provides to the U.S. is around this idea that we are really nearing the end of our inflation journey. And we've seen this time and time again, right? When things begin to roll over in China, that does have an impact on the rest of the world. So I think that this could very much aid the inflation story in the United States. Where I'm a little bit more concerned is if it undermines a broader growth narrative, then we've simply killed inflation and killed growth as well, which is not what markets have been pricing in.
Inflation data tomorrow morning, on to PPI on Friday. Mike McKee has more. Morning, Mike.
Good morning, John. Well, we all know the numbers. We're expecting a slight rise in headline inflation, a slight drop in core, with both of those coming in on a 0.2 increase per the month of July. But it's really going to be a question of where you sit and what you're looking for, because there are political components to this and there are monetary components. Joe Biden is going to be looking at gasoline, beef, mortgage rates, and I'm using beef as a proxy for a lot of food prices. Beef prices are skyrocketing lately. That's the kind of thing that Americans notice, and it's a reason why you see some consumer confidence concerns going forward. Powell, on the other hand, is watching things that are going down. Housing, is it going to go down even faster than it has? Used cars, you just mentioned, they're down 11.6% on a year-over-year basis, so that's put downward pressure on inflation. And apparel costs have been leveling out and starting to fall. And of course, the biggest thing in here is the base effects. As I mentioned, a 0.2 drop last month, a 0.2 drop forecast for July, and there was no inflation basically a year ago. So we will see some sort of headline increase, but the month over month is what you want to see, because that's what would show the Fed that there is sequential progress being made. And then, of course, for the Fed, which is starting to talk about what they might do in September, it probably isn't going to be anything yet, but here's the dates to watch ahead. We get the PCE price index. There's the last day of the month, and then in September, lined up in a row, August jobs, CPI, and then the Fed meeting. So still a lot of data to go, but this will be a marker along the way. Won't be definitive tomorrow, but it will give the Fed an idea of whether they're still making progress.
And Mike McKee, Jackson Hole just around the corner. For Chairman Powell, you and I have been talking about this. Is it too early for him to say anything definitive about the progress they have made and what it could mean for policy going forward?
I think so. I mean, he will probably, if he talks about current economic conditions and doesn't talk about the subject of the conference, which is structural changes to the economy, he may talk about the fact that they have made progress, but I wouldn't expect him to go beyond saying we're data dependent and we're still watching the data.
Mike McKee, thank you. We're all watching the data relative to expectations, and we've seen surprise after surprise, upside surprise after upside surprise. This came from Max Kettner of HSBC, who's been bullish for most of this year, bearish last year, by the way, so right to be so on both occasions. He said this recently in a note published yesterday: we remain pro-risk. Near recessionary expectations still allow for further positive surprises in the coming months. David Leibovitz, can I come to you on that? Do we still have this reservoir negativity to feed on? Does that still exist?
So I still think that there is a healthy amount of skepticism out there. You know, as we travel around and talk to clients of all different shapes and sizes, you know, we hear concern. We hear, well, look at core inflation. It's proving to be stickier. And, well, you know, the economic surprise index has been trending higher. And, you know, we've just been beating the data. That has to roll over at some point. And so I do think that you have this inherent skepticism amongst at least part of the investor base. And I wouldn't necessarily disagree with the point that you just made. You know, it does feel, particularly from a technical perspective, like there could be some more room for this rally to run. I think the bigger concern from where I sit is what lies ahead in 2024. You know, what happened back in March around the banks failing and the Fed injecting liquidity, rates moving lower, that reset the shot clock on any sort of softer growth, any sort of downturn. I simply think that that's been pushed into 2024, and markets are not grappling with that, at least not quite yet. And so to me, that's going to be the big story. Yes, in the very near term, there's probably more room for this market to run, but we do see some clouds forming on the horizon, and we think that that will begin to weigh on risk asset performance later on this year.
We had this conversation yesterday, and I think it's worth having again. Patrick, earnings relative to expectations have been good. Earnings relative to where we were last year haven't been great. What is the more relevant benchmark for you?
I always look at, you know, what direction are we heading into, right? And so it's really earnings relative to last year. How did we do? And what's the impact on earnings? I mean, the biggest thing that we've seen across the board for the last 2 quarters has been labor. I mean, labor, honestly, has not been this strong in decades. And we see it constantly. You see, you know, threats of strikes looming. You know, you had this UPS strike averted over the last, you know, week and a half. So I think we're going to see more of that. I think that has an impact on earnings. I don't think that's going away. I mean, let's think about labor for a second. If we avoid a recession, right, and, you know, where are we going to see, you know, unemployment next year? I mean, will it be under 3%? I mean, if we see that, we're just going to see continued, I think, overheating and, you know, potential, you know, more stress, upward stress with inflation. So I think those are things that the companies are going to continue to have to deal with. And what we've seen of late is that earnings are under pressure because of those significant cost pressures that are not going away.
170,000 over at UPS in 5 years for the average delivery guy. David, they're pretty big numbers coming out of companies like that. How sticky are costs going to be? And some of these domestic-facing companies going to be able to retain that pricing power we've witnessed over the last couple of years?
So we wrote about this a few weeks ago, and when you look at pricing power and you think about it, and more importantly, when you listen to what company managements say, they talk about, one, their specific basket, right? So they're not talking about CPI. They're talking about the input costs into their process, of which labor is obviously a significant one. They also talk a lot about demand. And I think that that's where a lot of people may be missing the mark, because when we look at the consumer, you know, the consumer looks fine today, but the consumer is beginning to bend. They're not broken, but they're in the process of bending. And so I do think you're going to see demand begin to fade here. That could very well coincide with a cooler labor market. That's going to undermine the pricing power that's allowed a lot of these companies to keep their heads above water over the course of the past 18 months. And so to me, the narrative is going to change here. We're going to see margins get squeezed more significantly. If you can't pass those prices along and you've already cut back on your investing, there's only one lever left to pull, and that's the employment one. So we do think that this is going to begin to show up more, not only in commentary, but also in the data as we move into the fall.
David, Patrick, stick with us. Your equity market at the moment, just a little bit firmer, but fading going into the opening bow with some movers here. Here's Abby.
John, we have Disney popping higher this ahead of reporting earnings tonight. It's one of these interesting quarters where the numbers, the top and the bottom line, matter less than a plan around the media assets. Well, it seems as though they're announcing some of those plans ahead of the quarter. They are getting into sports betting with Penn Entertainment. They will receive $1.5 billion over 10 years to let Penn use their ESPN bet name in the U.S. This has competitor to Penn Entertainment, DraftKings, down 5.7%. And then WeWork absolutely plunging, now a 16-cent stock, down 25% today. This after the company yesterday basically said that there's severe going concern risk, that they basically doubt whether or not they'll be able to stick around on the company's losses, liquidity needs, churns, and all of this having to do with weakness in the U.S. property market.
Valued at $47 billion in 2019, and now this morning, a couple of $100 million. Amazing. Abby, thank you. Coming up, the president hitting the road to promote Bidenomics.
I signed the largest climate bill in the history not only of the United States, but literally in the history of the world.
That conversation still ahead.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I signed the largest climate bill in the history not only of the United States, but literally in the history of the world. It will save working families thousands of dollars a year if they install rooftop solar or weatherize their homes. It also creates enormous employment, enormous growth, and things that better people's lives.
President Biden speaking in Arizona yesterday, kicking off a tour of Western states promoting his Bidenomics agenda. His next stop, Albuquerque, New Mexico, where he's set to deliver remarks at 3 p.m. Eastern. Kaylee Lyons has more from Washington. Hey, Kaylee.
Well, John, it's intentional that the president is in the American Southwest making this pitch on climate. States like Arizona and New Mexico, where they have been seeing extreme heat this summer. And as we just heard from him there, he is trying to promote himself as a climate president, because it was a year ago, essentially in August of 2022, that Inflation Reduction Act did pass, which include funding for projects related to clean energy and other measures as well, like incentives to accelerate that clean energy transition. The thing about it, John, is that this isn't necessarily resonating resonating with the American public. The Washington Post and UMD actually released a poll yesterday that found only 3 in 10 Americans say they have a good or great understanding of what the Inflation Reduction Act even is. And 57% of Americans disapprove of Biden's handling of climate change. So that really speaks to the fact that this package, while some things did hit immediately, those tax incentives, for example, on EVs or other clean energy products already are there for the taking, a lot of this is going to take a lot longer to realize. The same goes for his other legislative accomplishments, the infrastructure package, or the CHIPS Act, which was actually signed into law a year ago today. While we have seen announcements made, projects launched, the full effects may take a greater time to realize. So as the president is pitching Bidenomics to voters who are going to head to the polls in 2024, they may not just be feeling the full effects of it just yet, John.
Katie, we got a monthly report from the U.S. Energy Information Administration released just yesterday. And in it, I'm sure you've seen the numbers, all about crude output in America reaching maybe close to 13 million barrels a day by the end of 2023. How is that number playing out down in Washington?
Well, the energy policy question is an interesting one for this administration because, of course, if you remember, John, when oil prices were incredibly high and the president was dealing with higher prices at the pump, trying to bring them down, he was encouraging other countries like an OPEC, to be pumping more oil. And we had the releases of the Strategic Petroleum Reserve. So this has been a constantly difficult equation for this administration to navigate as he does try to promote himself as a climate president, but has also signed off on other products that would actually not necessarily fall into that category, like we've seen earlier this year, John. So a difficult one, definitely. And as he pitches the energy conversation and the energy transition conversation, it probably is a little bit of an admittance that you're going to need to rely on traditional energy sources in order to really get there in the interim.
The crude output could hit a record later this year in this country. Amazing. Katie, thank you. Just the latest on the US and Saudi Arabia, just a story that came out in the last 30 minutes I wanted to share with you again from the Wall Street Journal. Here's the lead paragraph from that story. The United States and Saudi Arabia have agreed on the broad contours of a deal for Saudi Arabia to recognize Israel in exchange for concessions to the Palestinians, U.S. security guarantees, and civilian nuclear help. This according to U.S. officials speaking to the Wall Street Journal. There's one line here that I think is important. U.S. officials express cautious optimism. In the next 9 to 12 months, they can hammer out the finer details of what would be the most momentous Middle East peace deal in a generation, but they warn that they face long odds. The latest from the Wall Street Journal just moments ago, the last 30 minutes or so. I want to turn back to Wall Street and what we're expecting with Treasury issuance out of Washington. Yesterday, 3-year notes, $42 billion worth, no problem. Today, more supply, 10-year notes, $38 billion worth. Tomorrow, 30-year bonds, $23 billion worth. David Leibovitz, do you see any problems on the horizon absorbing that debt?
So, you know, yesterday's 3-year auction was pretty good. I think that generally speaking, you know, the bond vigilantes have made a bit of a reappearance. And so, you know, there may be some modest issues digesting that supply, but we don't really expect anything to move, you know, significantly off the rails. I will acknowledge, though, that, you know, last week when we saw the U.S. debt downgraded by Fitch, that to us was very much noise. I think what caused more volatility in the Treasury market were actually the amount of debt that was released that the government is planning on issuing here over the remainder of 2023. And so, you know, our thought is that it's something you certainly need to watch. I would highlight that interest rate volatility remains well above other measures of equity market volatility and FX volatility. So not necessarily sounding the all clear, but, you know, not expecting any significant problems between now and the end of the week.
Patrick, how big a test is it later today and into tomorrow?
Well, I would say one thing just around the downgrade. You know, when you look at the last time the U.S. debt was downgraded, you know, in 2011, you know, the trend for rates was lower. And now the trend for rates is higher. So I actually think that the downgrade did have an impact. But I will say, you know, I would agree in the sense that, you know, the bond vigilantes have sort of reappeared and do have an impact. And, you know, basically saying that, you know, the bond market in some way is potentially taking over where and how rates move, you know, in the coming, you know, in the coming weeks and months.
Patrick, just out of interest, what kind of impact do you think it had, given everything else that was going on at the time? That additional supply that came out of Treasury that David talked about, developments of the BOJ, confusion around yield curve control. What is it about what Fitch said that you think actually is having an impact?
Well, when you think about just the amount of debt, and obviously the fact that, you know, Washington now there's there's a sense of unease, among the populace with how Washington, handles things like the debt ceiling. I think that's a big issue that's not going away, and I certainly don't think it's going to go away in the 2024 election season.
Patrick Rossetti, David Leibovitz, the two of you. Gents, thank you. The broader market fading just a little bit on the S&P 500, going into the opening bell about 8 minutes away. We're positive here by 0.1%. Into the bond market, ahead of that 10-year auction a little bit later, your bond market basically unchanged. The 10-year 4.02%. The 2-year yield higher by a single basis point at about 4.77. Looking at foreign exchange, the euro stronger this morning by 0.2% against the dollar. That currency pair 109.82. Coming up in the morning calls and later, Bank of America reversing its U.S. recession call, providing a bullish backdrop for small caps. The thoughts of Bank of America's Jill Carey Hall about 8 minutes away.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Equities at the moment about 5 minutes out from the opening bell. Chopping and changing, positive by about 1/10% on the S&P. No drama here on the Nasdaq, a similar move. Yesterday, a close below 4,500, but just in and around that level over the last week or so. The weakness, of course, last week, the biggest weekly drop since around about March. Trying to bounce back from that, but struggling right now. That's the equity story. The source of the concern last week in the bond market, a bit of stability over the last couple of days. Your 10-year at the moment going absolutely nowhere. 4.02% on a 10-year yield going into an auction later on this afternoon from the 10-year maturity out of the Treasury. Tomorrow, a test further out along the curve on the 30-year. The 3-year, no problem. Didn't expect one. The real test is further out along the curve after the move we've seen over the last week. So that's the bond market story. Let's get you some morning calls and start with a call from Luke Capital, downgrading UPS to hold. Let's see the price target, 195. Seeing limited room for improving margins this year. The stock is down by about 0.9% in the pre-market at 179. Next up, Barclays upgrading Dish to overweight, expecting deals with T-Mobile and EchoStar to serve as potential catalysts. That stock is positive there by 2.15% to $8.55. And your third and final call from the team at Jefferies, upgrading Eli Lilly to buy, highlighting the company's upbeat results and new obesity drug. Some of those names are absolutely flying at the moment. That stock is up by 0.2% in early trading. Coming up, Bank of America's Jill Carey Hall expecting a soft landing to mean big things for the small caps this year. That conversation coming up, your opening bell just around the corner.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
We are fading going into the opening bell here, still just about positive by almost 0.1% on the S&P, on the Nasdaq up by 0.07%. After the close a little bit later, the focus shifting to the Walt Disney Company. That's the next big earnings story after the bell a little bit later. There's your opening bell. Switch to the board and get to the bond market. A test for the bond market later, a 10-year auction today, this afternoon. On to tomorrow, a 30-year auction out of the Treasury. Your 10-year yield just about unchanged, 4.0161%. on a 10-year. Yesterday, dollar strength. Today, a touch of weakness against the euro. 109.85, positive there by 0.26%. Deflation in China. Kit Jukes of SocGen saying, why is the euro not weaker? This morning is stronger. In the commodity market, a rally again for crude, up by a little more than 1%, up almost a full dollar this morning to $83.90. About 30 seconds into the session, here are the scores on the S&P 500, unchanged. On the Nasdaq, unchanged. On WeWork, anything but. Shares plunging after reporting Q2 results. The company writing this: as a result of the company's losses, projected cash needs and current liquidity levels, substantial doubt exists about the company's ability to continue. Abby has more. Hey, Abby.
Hey, John. Simply a stunning fall from grace. This company was founded back in 2010 on the idea that they would lease big areas of office space, then rent them out to the smaller player that wanted to have a shingle. They expanded in a huge way. Well, now, yesterday, as you mentioned, they talked about the idea that they have substantial doubts about whether or not they will be able to stay in business. It was an expansive trajectory, too. In 2019, they were actually the biggest leaser of office space in New York and London. They occupied millions of square feet, not just in New York and London, actually, but in dozens of countries. So it was one of the biggest startups, of course, when they IPO'd back in 2020. As you had mentioned earlier in the hour, a $47 billion market value. Now a roughly 16-cent stock, bleeding cash. They are cutting their occupancy rate as the churn continues. Looking forward to potentially stay in business. They're focused on reducing their rental costs, negotiating more favorable leases, and also increasing their revenue and raising capital. Management has been an issue, of course, John. So this stock basically down 98% from the 2020 IPO. It's not just the stock that's under pressure, though, John. The unsecured 2025 notes, well, they last changed hands for about 33 cents on the dollar.
Brutal. Down $100 million in market cap this morning already. The market cap right now, $348 million US. And as Abby said, down from a private market valuation back in 2019 of almost $50 billion US. Just Absolutely shocking. Elsewhere, shares of Penn Entertainment surging this morning. The casino operator signing a sports betting deal with ESPN. Morgan Stanley weighing in, writing the new branding strategy for Penn could be a game changer as the company divests Barstool and utilizes one of the best-known sports brands in the US. Katie has the story. Hey, Katie.
Hey, John. Well, Penn shares absolutely soaring right now, currently up by about 13–14% at the moment. That was after it was up as much as 35% pre-market on news that it did ink that deal, that exclusive U.S. online sports betting deal with ESPN. Now, this gives Penn exclusive rights to the ESPN Bet trademark for an initial 10-year term. And as such, Penn will rebrand its online Barstool Sportsbook as ESPN Bet. And Penn has divested Barstool Sports back to its founder, Dave Portnoy. Now, the sell side is absolutely psyched. As you mentioned, Morgan Stanley said this new branding strategy is, quote, a game changer, while you have the likes of Truist saying that this could help Penn become a, quote, major player in the online sports betting arena. And as a result, as you might expect, you have shares of competitors down this morning. If you take a look at DraftKings, for example, currently off by more than 7%.
Dave Portnoy, Katie, can we sit on that for a while? That company went for what, 500 million plus back in 2020?
Yeah, I would love to know how much it was sold back to Portnoy for.
Zero. Just amazing, amazing. Katie, thank you. Just remarkable. It's like a reverse SoftBank for Dave Portnoy. Let's stick with DraftKings. Katie mentioned it. JP Morgan recommending investors buy the dip. We're using this price weakness to up our rating to neutral from underweight. At current levels, we see the shares valuation as more imbalanced and believe a neutral rating is more appropriate. That's the story for them. DraftKings is down by 6%, as Katie mentioned. That stock is struggling. Let's turn back to earnings. Rivian boosting its production target of 52,000 vehicles, up from 50,000 earlier. The company expecting heavy losses to continue, but adding, quote, increasing our production is the primary lever in our path to profitability. David, how is that quest for profitability this morning?
It's not going very well because the company's saying they're going to be losing money going forward, and they lost quite a bit. 2,000 units of production is not a lot, especially when you're only at 50,000. It's going to be difficult for Rivian and some of these other electric vehicle startups to get to production scale because there is a sense that EV buyers tend to be wealthier, but there are only so many of them out there who can buy $70,000, $80,000 vehicles, and unless you have something cheaper that can get to the mass market, it's tougher to get scale, and we're not really seeing that just yet. So there may be a cooling off period in EV growth coming. Not that it won't keep growing, but for a player like Rivian, getting out of this big loss zone and into a situation where they can make money, it's going to be a lot of work going forward for them.
David, what is happening with demand for EVs? What is happening with global inventories? Is it just Rivian, or are you seeing it Tesla? Are you seeing it across the board?
We're kind of seeing it across the board. I mean, Tesla has lowered prices in China, and they still had a big hit. Sales were down 31% there in July. You've seen prices drop here. Look, EVs are still growing, but I think the growth rate is slowing, prices are coming down, inventory is coming up, a lot more competition coming into the market. If you're Rivian and you're selling electric pickup trucks and SUVs, you've got General Motors with a Chevy Silverado EV coming out. You'll have a Ram pickup from Stellantis coming soon. Ford is increasing production of its Lightning pickup truck, and the Cybertruck is coming from Tesla fairly soon. So 2024 is going to be a tough year for them in terms of truck competition, and there are more electric EVs too, at a time when the growth is still there, but slowing down. We're getting into sort of a cage match here among EV makers in the next couple of years.
Quite literally, in some cases, there might be a cage fight. Anyway, David Welch, thank you, sir. I've got no idea what's happening with that cage fight with Elon Musk and Mark Zuckerberg. We'll see. Watch this space. I'm sure you're all excited. Sticking with auto, shares of Lyft under pressure after reporting its slowest revenue growth in 2 years. The CEO remaining optimistic, saying, quote, we're creating a healthier business. Going forward, our strategy is to price in line with where the market is. We're not planning on making any major price changes. Mandeep Singh joining us now from Bloomberg Intelligence. Mandeep, that stock's getting hammered. How do they stack up versus Uber right now?
Well, so with Uber, we saw pricing was a nice tailwind. And in the case of Lyft, clearly they are being aggressive about their pricing. And look, this is, a market where subsidies and aggressive pricing is what hurt the unit economics to begin with. And I think Lyft is going back to really being aggressive on pricing. And to my mind, they have a problem both with supply acquisition as well as incremental margin. at this type of pricing, they'll find it very hard to generate any free cash flow. And they definitely don't have the scale to compete with Uber. So clearly, I think the odds are stacked against them when it comes to unit economics and profitability.
Is there anything good to say about what they're doing right now, Mandeep?
We know ride sharing potentially could generate about, 20% EBITDA margins. That's what Uber has done. That's the profitable part of their business. If you go back to, where marketplaces have done well, look at Airbnb or Booking. It's the exclusive inventory is what makes them profitable, and that really is on the supply side. So in the case of Lyft, a B2B partnership or something exclusive to differentiate themselves from Uber is what will, I think, help them develop a sustainable business.
Down 9% right now. Mandeep Singh from Bloomberg Intelligence with the update. Mandeep, thank you. The broader market is slightly negative on the S&P. 8 minutes into the session on the NASDAQ, we're negative here by 0.2%. Bank of America recently reversing its recession call. I'm sure many of you heard about that. Strategist Jill Carey-Hall weighing in on the potential market implications, writing this: we're now forecasting a soft landing, a bullish backdrop for parts of the market that have been pricing in a recession. This includes the US small caps, which remain historically very cheap when compared to their large cap peers. Jill Carey-Hall, I'm pleased to say, joins us right now. Jill, if you don't mind, we have to start with Mike Apen and the call on the economy first. Let's start there and then move it over to the equity market. What is it that the economics team over at B of A, Jill, is seeing that gives them the confidence we can avoid that recession?
Hi, good morning. Thanks for having me. Yeah, I think we're seeing more resilient than expected macroeconomic data. Consumers remain relatively resilient. So we're now no longer expecting GDP growth to turn negative. So we expect, growth will slow next year, but no longer officially a recession, more of a soft landing. So, I think with that, we have seen a number of parts of the market, whether it be cyclicals and high beta stocks, whether it be US small caps, that have been, either discounting a recession or where investor positioning has been extremely underweight or both. So those are some of the areas of the market that we're most positive on right now. Within the S&P 500, we like cyclicals, we like higher beta stocks. We expect leadership to broaden out. So we like the equal weighted S&P 500 over the cap weighted S&P 500. And then we do see tactical upside for US small caps.
I should say the soft landing call was made by Mike Apen in the last couple of weeks, but Jill, you and Savita upgraded US equities coming into the summer, looking for that broadening out of the rally, calling for an equal weight, a shift to the equal weight. But Jill, I have to say, you've also been a bit more nuanced when it comes to tech. It's not like you've just thrown the towel in on US technology. Could you give me your more nuanced view on US technology right now, what you don't like and what you do like?
Sure. I think, with tech, there are obviously a lot of interesting stories going on within the sector in terms of AI. That's something that while there is a lot of potential for private companies that could become public mid caps, a lot of the bigger beneficiaries of that theme are in large right now. Tech still has clean balance sheets and cash return for some of the stocks. So, tech is a sector where we would prefer large caps over small caps within tech. A lot of smaller tech stocks are still non-earners, non-profitable stocks, higher risk, lower quality. So we've had more of a neutral view on tech, but not necessarily expecting huge downside for the sector. We just expect at this point that leadership could broaden out to some of the other parts of the market after we saw such strong leadership by some of the tech stocks within the Magnificent Seven, as it's been called.
Jill, within what sectors would you be more constructive on small caps over large?
So I think, sorry, your question was?
Within which sectors would you be more constructive taking exposure with small caps and not large? You mentioned the difference there for technology. Where would you be more constructive taking that exposure on small caps instead of large caps?
Right. So I think a number of the cyclical sectors within small caps look pretty attractive right now. So, consumer discretionary overall ranks very highly in our small cap work. Areas like materials and industrials, a lot of these sectors are trading at, pretty steep valuation discounts to history. We are seeing within this earnings season, CapEx by S&P 500 large cap companies has held up pretty strongly. You're still seeing positive CapEx growth. That tends to benefit domestic SMIDs. You're still seeing, reshoring happening. That should benefit a number of, domestic SMID cap industrials and several other sectors. So, those are some of the areas that rank particularly well within small right now. I think, the areas that we'd be conversely more cautious on small than in large would be tech, as I mentioned, financials, given the regional banks exposure in small, and then healthcare, where, similar to tech, you have a lot of non-profitable stocks within small caps, still a lot of the lower quality stocks that we do see risk to, especially if, interest rates continue to go up, credit conditions continue to tighten. I think refinancing risk is still something you have to watch for a number of parts of the SMID cap size segment as you move out, to 2025 and beyond, when a lot of maturities come due.
That maturity wall is just lingering there on the horizon. I know a lot of the credit teams are focused on the same thing, Jill. Could we just finish on pricing power? We're getting deeper into earnings season now, Jill. What have we learned about that so far? Are we retaining pricing power in America? Are we losing it? Are costs still sticky at the same time? And ultimately, what does that mean for the outlook for margins?
So for U.S. corporates, we're still seeing, margins remain pretty resilient. When you look at the earnings beat this quarter, both within large and small caps, for most sectors, it was margin driven, bigger earnings beats relative to sales beats. So, you've seen cost cutting, you've seen layoffs, you've seen, a number of factors where companies have been able to price through. So we have seen margins hold up rather resiliently, kind of across the cap spectrum so far.
Jill Carey-Hill of Bank of America. Jill, thanks for the update. As always, it's good to see you. 14 minutes into the session, we're down on the S&P by 0.16%, on the NASDAQ a little bit softer. Coming up on the program, Walt Disney getting into the gambling business.
Yes, ratings are down, cord cutting is up, content costs for sports rights are up. So they're in a tough spot. I think Disney will figure out how to make money at those revenue levels. So you can't lose your sight of the big picture here.
That conversation coming up.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case. And
and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is
vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This appears to be a real solid deal with a big player and a sizable monetary commitment, $1.5 billion over 10 years. So a very integrated deal, interesting. But I think the future of ESPN in terms of all streaming, not all streaming, partner coming in, investing in it, that's much larger aspirationally than this side deal.
ESPN is getting into the sports betting business, striking a deal with casino operator Penn Entertainment. The network's saying the deal provides us with a tremendous opportunity to serve the ever-growing number of consumers interested in betting. This coming ahead of earnings later on after the bow from the Walt Disney Company. Your team coverage starts now with Katie Greifeld, Geetha Raghunathan joining us. Katie, it's hard to say this, almost unbelievable in some ways, that the Walt Disney Company is getting into sports betting.
It is, yeah. To get into the specifics of this deal, you have Penn. It's going to make $1.5 billion in cash payments to ESPN over an initial 10-year term. It will also grant ESPN warrants to purchase nearly $32 million worth of Penn shares. That's in exchange for media, marketing services, and other rights, including exclusive rights to the ESPN Bet trademark for that initial 10-year term. Penn is going to rebrand its online Barstool Sportsbook as ESPN Bet. As we covered, Penn has divested Barstool Sports back to its founder, Dave Portnoy. You take a look at the shares. I think this is fascinating. Right now, Penn currently up about, 10% or so. At one point already today, and trading just started, up 18%. That would be the best day since November 2020. Going to be really interesting to watch this into the close.
Quite a rally. Interested after the close with the earnings as well of the Walt Disney Company. Geetha, let's talk about that. How does ESPN fit in to the overall strategy, given the direction of travel they're going in?
Yeah, there are so many different questions up in the air for Bob Iger as Disney kind of reports today. And of course, one of those prime questions, John, has always been this future of ESPN. I think, as Katie and you just pointed out, this is a good first step. I think it's a good win for ESPN. They have this kind of double whammy situation where their top line is being pressured obviously by cord cutting, and then the bottom line again because of rising sports costs. But it's still a business that generates about $13 billion of revenue, about $3.5 to $4 billion in EBITDA. And with this new Penn deal, of course, now they're getting like high margin revenue, an additional, $1.5 billion over 10 years. Because again, we're going to have to see what Bob Iger kind of outlines in terms of strategic vision, because again, the future is a little bit murky. We'll have to see if they're still open to kind of doing that equity stake deal, talking to the leagues or any other partners.
Let's talk about that now. After the bell, Geetha, what are you and the team looking for?
So again, there are a lot of big, questions in terms of numbers, but I don't think the numbers itself are that important as, again, kind of all of these open question marks, right? What does Disney do with the linear network business? Networks that Bob Iger has called non-core. Are they going to purchase the Hulu stake from Comcast, and will they be willing to pony up the $10 to $12 billion? And then again, what's happening with the parks? There's been some reports of maybe declining attendance. They're also going up against some very tough comparisons from the 50th anniversary celebration for Walt Disney World last year. So we're looking at all of those numbers, obviously parks profitability, direct-to-consumer losses, which are supposed to increase a little bit sequentially into this quarter. And then, of course, the linear TV business is also under tremendous pressure. Advertising could be down anywhere from about 10 to 12 to 13%.
What a difficult time for Bob Iger for the Walt Disney Company. Geetha, thank you. Geetha Raghunathan there. Katie Greifeld on the latest sports deal with ESPN, and going forward from here, earnings after the bow with Walt Disney. Looking forward to those, as many of you are. Equities right now on the S&P 500, 22 minutes into the session, we are negative just a little bit by 0.1% with a sector price action. Here's Abby.
Yeah, with that small decline, John, we actually have more sectors higher than not for the S&P 500, but it's the heavyweight sectors that are weighing, including technology, consumer discretionary, and communication services, all of those mega cap tech sectors. On the other hand, you have energy up 1.3%, utilities, healthcare also higher. There's a little bit of a defensive tilt with utilities and healthcare near the top of the pile. Where we have some really interesting moves is the video game sector. Take-Two had been soaring earlier today, up 3.4%. Last time I looked, up just a little. Actually, now it's down, but they actually are predicting big 2024 performance. But you can see SciPlay is up 15.5%. This is Light & Wonders to acquire the remaining 17% stake. And then Roblox down 21%, John. I'm sure that you, similar to me, are kind of surprised to hear this, but it's sliding because the hours spent playing video games missed the targets. I didn't even know that.
Isn't that a good thing?
Yeah, I would think it is a good thing.
People socializing out there in the real world.
With the beautiful weather.
Not on video games.
Agreed.
Abby, thank you. Trading Diary, up next.
And money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg.
Just a little bit of weakness emerging in the last 15 minutes or so. We're negative here by 0.1% on the S&P, and the Nasdaq down about 0.5%. That's the price action. Let's get to the trading diary. Interesting 24 hours coming up for you. The US Treasury selling $38 billion in 10-year notes at 1 p.m. Eastern Time. On Thursday, another $23 billion of 30-year bonds. On the same day, it's the main event. It's the main event of the week. It's US CPI. Fed speak continues from Raphael Bostic and Patrick Harker. And then we round out the week on Friday with US PPI and the UMich Consumer Sentiment Survey to see if we make any more disinflationary progress going into next month's Federal Reserve meeting on September 20th. And Jackson Hole later this month, somewhere between the 24th and the 26th of August, you might hear from Chairman Powell on the latest data. That does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Fed was going to keep rate while this is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. Well, after 2 straight days of solid work, Matt Miller taking a little bit of a rest day today, but not to worry. Jess Menton is here filling in. Hopefully Matt is doing well here. He's like a major league pitcher, a couple of days work, and then we got to give him a breather. Vince Signorella, he shows up. I don't know what's going on with him. He's a macro strategist, usually the work from home king, but he's here in New York showing his face. Must be important. And then we need to get to the bottom of what's happening in China. Some disappointing economic news out in China. Tom Orlick, he's a chief economist for Bloomberg Economics. He spent about 10 years in China working there and studying their economy. He's going to join us here and give us the lowdown. And then Carol Murphy, CIO at Kestra Investment Management, one of the smarter folks we chat with. She's going to come in and give us her thoughts on where this market is going as we await some key economic data coming out tomorrow. But first, let's kick everything off with John Tucker. He shows up every day. He's got a Bloomberg Business Flash.
All right, Paul and Jess, in the run-up to the key inflation data tomorrow, traders reluctant to jump in with any big bets. The parade of earnings also continues. Carvana advancing, raising its profit outlook. Lyft retreating, the company reporting the slowest revenue growth in a couple of years. And meantime, Crossmark Global's chief market strategist Victoria Fernandez sees a rise in concern among investors.
Yeah, it's gone up definitely over the last quarter. Each meeting that we have, people are concerned because we've been telling our clients we think there's going to be some choppiness here. We think we're going to see a pullback in the fourth quarter of this year, so we need to be prepared for that. So they're getting a little concerned.
Right now, the S&P 500 down a point. Dow Jones Industrial Average up 41 points. The NASDAQ 100 down 56 points. Ahead of tomorrow's CPI bond market measure of expected inflation. This is the 5-year inflation break even, rising back to a 9-year high. I'm guessing this has absolutely nothing to do with Tesla's stock price. Tesla is selling a cat bed shaped as a Cybertruck. This is serious, Bailey. It is made of cardboard, also has a scratching post. Right now, it's only sold in China, $13 for a Tesla. So there you go. That is your market update. And we do this all day long, basically.
Yes, we
all
do.
Day.
John Tucker. Back to Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Metten sitting in for
That's
Matt
right.
today. Paul
You were
Sweeney.
surprised to see me.
I might have been a little harsh on Matt earlier. Turns out senior management has just reached out to me and let me know that Matt is not taking a rest day. He's actually preparing for an interview that we will broadcast here at 12:12 p.m. Wall Street time. General Motors President Mark Royce is going to join Matt for a conversation about General Motors and what's happening there. So Matt's preparing for that, and that'll be a great interview. We'll bring that to you later on today, but just sitting in for Matt. We appreciate it.
Always excited to be here.
We are live from the Bloomberg Interactive Broker Studio. We are also broadcasting live on YouTube, so just heading over to that YouTube thing and search Bloomberg Global News, and that will take you to our feed. Right now, let's get a look at these markets. Kind of mixed here. S&P and Dow up just slightly. NASDAQ taking a little bit of a breather off about 0.4%. Let's see what's happening under the hood. We can do that with Bailey Lipschultz. He covers all the markets for us, and he joins us here in our Bloomberg Interactive Broker Studio. Bailey, what are you looking at today?
Yeah, energy outperforming this morning. Biggest really sector actually moving in the S&P 500. That all because crude right now trading at the highest level since mid-November. Looking at volumes, though, super light, really about 40% of normal over the last 100 days on the S&P 500, closer to 60 on the NASDAQ 100. But there are plenty of stocks moving under the surface. Roblox, the video game company, down 20% this morning. Really kind of weakness across the board. Adjusted EBITDA disappointing. Daily active users and engagement missing expectations. So a pretty sharp move for what once was one of the many pandemic darlings of this market. Other stocks that are moving to the up and downside. Penn Entertainment partnering with ESPN, stocks up 15%, and competitor DraftKings down close to 9%. Looking back across the pond, Flutter Entertainment, the owner of FanDuel, down more than 3%. So kind of a bit going on under the surface in what, again, on the surface level is a day that nothing really is going on in terms of moves up or down in the key benchmarks.
I know you were also taking a look at what's happening with Axon Enterprise. This is a public safety technology company if you're thinking about tasers, body cameras, but that's up about 17% on pace for its best day since June of 2020. What are you seeing there, Bailey?
Yeah, analysts crediting beating expectations for their new products like the Taser 10 and the Axon Body 4 camera. So strong results. It does seem like, at least according to analysts, they are seeing product innovations helping drive new growth as well as different market trends across the public safety space. So looking like Axon, which is one of those many companies those handful of companies that we keep an eye on when things kind of get unrest, broadly speaking, having its best day since early November. So really a strong move for the stock, but still not quite near those highs that we saw back in April.
We keep talking about how we all need to go to Kava, right? Some of these recently listed IPOs on the market, but Paul, Bailey actually did another story on Kava, taking a look about how this rally in this, what's going on in the IPO space might potentially be overdone. It's one of his latest columns. Walk us through what you're seeing there.
Just really talking to bankers and investors, kind of the buy and sell side, talking down expectations for really an IPO rush. You're looking at Kava still up close to 140%. Oddity, which is another consumer-facing company, up closer to 50%. But it does seem like it's slowed down, or there's been kind of this expectation that we're going to have a mad rush with Birkenstock, ARM, Instacart, other household names going public. But the bankers and investors that I've been talking to are kind of saying maybe that's going to be more of a first quarter to second quarter time frame as opposed to a big rush post Labor Day.
I'm looking at Carvana. Carvana boosts profit forecast as turnaround gains momentum. That's a stock you don't know what to do with. It's been all over the place. It seems for a while there's kind of left for dead here. The stock's a little bit unchanged today, but up 800% year to date. But at least their numbers suggest that the business is perhaps more stable than some of the bears had thought just as recently as, kind of late last year.
Yeah, we saw the stock trading below $4. Right now it's above 43, but the big kind of sentiment has been, will car vending machines actually be something that's profitable? Is this a business that actually is going to deliver? And when you look at kind of their adjusted EBITDA expectations for more than $75 million, showing that, you know, they're a bit more positive than they had been. This, as you mentioned, really was a stock that was kind of left for dead. But again, if you bought the stock back in 2021 near the peaks, it was trading north of $370. So
yeah,
at 43, you're still down quite a bit.
Yeah, it's interesting. I'm just looking at the FA function on the Bloomberg terminal. It gives you some of these the forecasts for the business here, and it looking like Street expects it to have some positive EBITDA this year, maybe 200 million. And then going to 300 million next year, and maybe 600 million the year after that. So, but still negative net income. So EBITDA positive, but still negative net income for this company.
In looking at that FA function, they've got, according to the terminal, north of $8 billion in debt.
Yeah.
So when your market cap is less than your debt and your cash is basically non-existent,
that's tough.
usually
That's
not a
tough.
positive
Yeah.
thing to keep an eye on.
All right, yeah, I'd rather own the equity perhaps than own the debt here in this particular name. So much good stuff. Bailey, thank you so much for joining us. Bailey Lipschultz, he covers all the markets for us. And again, kind of a little bit of a weight to the tape here. S&P and Dow pretty much unchanged. The NASDAQ off about 0.5%. Vince Signorella joins us. That in and of itself is newsworthy. He covers all the markets. Yeah, absolutely covers all the markets for us. And Vince, what do you make of kind of what we're seeing in these markets here? What jumps out? We're going to get a lot of inflation data tomorrow and on Friday. We've got a Fed that's looking, they say they're data dependent here. What are you looking at? What are the clients that you talk to, the traders that you talk to, what are they looking at?
The big story this week so far is China. What we saw from a big decline in exports down to a couple of years ago, just out the other day. We're also seeing some housing issues once again, real estate companies, builders, property managers all taking a bit of a hit. There seems to be, once again, an over-leveraged market in the housing market in China. And the PBOC in the past has stepped in to bail them out, but they're just teetering around, tiptoeing around the edges right now. They haven't stepped in yet. One would expect they would sort of do a 2008, whatever it takes, if a situation happened over there. But so far, they're standing back. And at least in the last 24 hours, investors are pushing that aside a little bit, more focusing on what CPI will be tomorrow, and focusing back on the Fed. And we are looking for a bit of a jump in the forecast for CPI tomorrow to 3.3 on a year-over-year basis from 3%. But the numbers have been tame. So if we do get a little bit of a beat to the downside, I think the markets are ready to roar. Hedge funds well overshort treasuries.
Yeah, talk to us about that trade, because I've heard the hedge funds, the smart money, so shorting treasuries, but then I read about Warren Buffett out there every Monday buying $10 billion of treasuries at the auction. What's going on in the treasury market?
So what we have is folks like Buffett, which are the asset managers, if you will. Yep. That's hard. That's solid money. That's people who are in it for the long term. They are long treasuries. Okay. The fast money, as it's referred to, which is the algo/hedge fund guys, are very, very short. So the deal for tomorrow basically is if you get the high inflation number or even a meet of a 3.3, even a 3.4%, you're going to see some sort of a sell-off in treasuries, higher yields, but not to the extent that you would see a bid in treasuries if it were the other way, because the fast money is going to cover, the asset managers aren't.
Gotcha.
When you're looking at China, such a huge importer when it comes to these industrial metals. If you look at copper prices today, up close to about 1%. What do you think the direction of copper prices is really telling us about the trajectory of the global economy? Because can you have a global recession if copper prices are moving higher?
I think what copper is telling us also has a referring to the housing market, especially here in the U.S. But what we're seeing, I think, is so China obviously is a major exporter to the world, and if China suffers, you would expect the rest of the world to suffer as well. But now, post-pandemic, a lot of companies have moved some of their supply chains away from China. Not all their eggs in one basket as much as they were before. So I think it's a little bit muted, and we'll get a better response to a slowdown in China than we would have, say, 5 years ago.
What are the markets you're looking at? Are you spending more time in treasury markets, currencies, commodities? What's got your attention these days?
I think the treasury market, I'm looking at the 530s, has gone out of inversion into a positive, more steepening curve. Really? I think the likelihood we are to see going forward, the pain trade will be a steeper curve where we'll see basically the short end will outperform the long end. If we see inflation moderate a little bit, we'll see the potential for the Fed to be on hold. If there is an effect of people looking to sell treasuries, they're going to want to sell them out in the long end. The short end is going to be where the real gains will come as the Fed starts to cut.
With the CPI report on Thursday, we've clearly seen used car prices come down and ebb even further. What indicators within the report are you going to keep a close eye on? Because it seems like when you're looking more at equities, not moving quite as much on those macro type data this year, obviously, as it would have had last year.
Yeah, I mean, the CPI is just such a mixed bag. I think what you really need to focus on is what really the consumers feel, which is the basics, food and energy. You know, car prices have come down a bit, which has been a big help, and volumes are up, which is interesting. It shows a consumer that's resilient. We get retail sales next week, and an economist who pointed the JOLTS data out to me a couple of months ago, and he was bang on, is actually expecting retail sales to beat. He sees lower income earners having more disposable income in the items that he tracks. So if CPI is temperate, you will see the same situation where potentially consumers having a larger share of disposable income, and those lower income earners spend their money. They don't save it. So they're kind of paycheck to paycheck. So if they get extra money, it's going to go out into the economy.
Well, I'll tell you where we're seeing some more inflation come back is in energy prices. I'm just looking at WTI crude oil up another 1% today to just under $84 per gallon. What do you make of that?
That's really an interesting play because that flies in the face of what's going on in China. You would expect oil prices to come down if demand was coming down. I suggest this seems to be more of a supply issue with Saudis promising more cuts. But you look at nat gas futures, I think are even more interesting. The front end contract for Europe's up 30% this morning, and nat gas futures here in the U.S. last I looked were up about 7%.
Why is that?
It's hard to say. I mean, we're in the middle of the summer. You know, you would expect that to be more of a winter thing. It could just be, you know, a trade issue, a supply-demand issue. It tends to be volatile, but it has been going up quite a bit lately.
I'm looking at the daily national average gasoline prices, regular unleaded, which Matt does not use regular unleaded because he's super high-tech. But for the rest of us, we use regular unleaded, as does John Tucker. $3.82. It's going to get your attention once again.
That's another focus of what I think will be CPI tomorrow, where we're looking at the energy prices and see how that's impacted inflation.
I have to point out, if you look quarter to date, energy in the S&P 500 is the best performing sector. It's up about 8.5%. When you're thinking about, obviously, technology and growth stocks leading the way in the second half, are you going to start seeing more of these kind of cyclically oriented types of sectors take the baton in the second half, potentially?
I think so. I think we'll see some of the larger cap techs that have been driving things, the Metas, the Apples of the world, take a step back and see some of the other sectors push to the lead. I think they've gone quite a bit and are due to cool down a little.
So what, in the, other than the CPI inflation data coming up tomorrow, which is going to be very important, what are some of the other data points that you think this Fed is really looking at? Is it the labor market? Is that kind of a key driver for them, do you think?
Yeah, I mean, they keep looking at labor. I'm a little confused by it. It's a backward-looking number. It's not a leading indicator, but they've got their claws in it. I think the JOLTS data is probably going to be the more interesting part of things. The expectation for the second half of the year is for job openings to decline. That will show a little bit of a slower, less heated labor market. If we get that, if we get tame inflation, if we see even a little bit of a steady economy out of retail sales, I think the Fed really needs to consider pausing. I mean, they've come so fast, so far, so quickly. And if you go on the terminal and you chart the Fed funds rate, the target rate, and you put over that M2, you'll see a real distortion because you'll see this big jump in Fed funds, but almost no change in the money supply. And to me, that just says they're changing the price of money, not changing the volume or the supply of money. They're not removing money from the economy. They're just changing the price of it and making it more expensive. And I don't see how you do one without doing the other and having that effect on a monetary policy.
Why are you in the city today?
I have a doctor's appointment.
I was going to say, it's either a doctor's appointment, he's got
Madison Mills and I saw him, I think it was last week, actually. He came in the afternoon, and it was great.
all cards on the table. I'm having a knee replacement surgery next Tuesday.
Are you really?
So far, but I have to see a specialist today to make sure I can go through with it.
Good luck.
All right.
I'm actually looking forward to it because I went from playing tennis to now I can't walk 2 blocks.
That's right. So you need, all right. Well, hopefully that'll fix things. Vince Signorella, global macro strategist for Bloomberg News, joining us here in studio, giving us his thoughts on these markets. And again, looking at the indices today, S&P 500 down about 0.1%, the Dow unchanged. The Nasdaq is kind of, we're seeing a little bit of action, off about 0.5% here. On the yield front, 10-year Treasury just off a couple of basis points, sitting right at 4.00% on your 10-year. We'll have more coming up. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, Italian banks and their shareholders are breathing a sigh of relief after the government tweaked a tax that rattled markets. Bloomberg finance reporter Sonia Cerletti in Milan has the latest.
The Italian government backtracked on part of its new windfall tax on banks, saying that it would introduce a cap to limit the impact for many lenders. This step back was due to try to calm markets after yesterday $10 billion were wiped out from the sell-off that hit Italian banks.
Thanks, Sonia. Bank stocks reversed some of those losses this morning. The head of the United Auto Workers flatly rejected a proposed contract from Stellantis as the deadline for a new agreement approaches. UAW President Shawn Fain slammed terms of the deal, which he says includes cuts to health care coverage, fewer vacation days for new workers, and lower contributions to retirement plans.
Stellantis' proposals are a slap in the face. They're an insult to our members' hard work over the last 4 years.
Fain, in a Facebook Live video, tossed a copy of the contract in a trash can, saying, quote, "That's where it belongs." And shares of Disney are up as the entertainment giant prepares to release second quarter earnings after the bell. The big concern for investors is about CEO Bob Iger's plans to restructure Disney's broadcast and cable TV operations. They'll also be looking at how many subscribers Disney added to its streaming platforms, including ESPN and Hulu. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up with Paul Sweeney right after this.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks kicking off today's trading with some muted moves so far. Investors awaiting fresh readouts in inflation. Of course, we get the CPI tomorrow morning. That's going to feed into expectations for future Fed interest rate policy. On deck for later today, Walt Disney reports earnings. That comes after the close of markets. Oil prices, they're rising right now. The best performing industry group in the S&P 500, in fact, that belongs to energy. Now, on that front, Bloomberg Economics is writing that the Fed's own model suggests they're slightly more likely to react to a positive commodity price shock, rising prices, by cutting rates rather than raising them. Right now, S&P 500 is 7 points lower. The Dow Jones Industrial Average down 13 points. The NASDAQ 100 right now 81 points lower. That is down about 0.5%. The microphone that Cardi B recently threw at a fan in Las Vegas has been sold on eBay. After 122 offers, the winning bid came in at $99,900. The nice part about this, all the proceeds, they say, will be given to charity. And I must admit, when I saw the headline Cardi B, I thought that was a medical procedure.
I know you did. Oh, I
didn't know that was a singer.
That was a singer.
JT, come on now.
It's definitely a generational thing going on.
Man of another time.
He really
That is
is.
your Bloomberg business flash.
Can I just say, I got a text from my mother recently, whenever I fill in with you, Paul, and she brought up John Tucker. She said, I'm getting more and more intrigued with John Tucker. He's like Clark Kent. There's a lot going under that slick veneer.
Oh, man, you got a fan out there.
Yeah, that prompts a couple of questions. Is mom single? Is she
No,
rich?
she's not. My parents have been married
okay.
for
Moving
over
on.
40 years.
Nice. Good job. All right, John, thank you so much. We appreciate that. Jess Menton, Paul Sweeney here in our Bloomberg Interactive Broker Studio. One of the stories markets are dealing with today is some economic data coming out of China, a little bit disappointing. Consumer and producer prices fell together for the first time in 2020, a deflation cycle, you could call it. Tom Orlick, he knows a thing or two about China. He lived and worked in Beijing for many years. He is the chief economist for Bloomberg Economics. He joins us via Zoom. Hey, Tom, you know, when we all came into 2023, I think most companies, most countries around the world said, hey, one of the stories of 2023 is going to be China reopening, and that's going to be good for the global economy. That's not really playing out, is it? Tell us what's going on with China and its economy.
I think that's right, Paul. If we go back to the end of 2022, start of 2023, there was a lot of optimism. China exited its COVID lockdowns quicker than most people expected, and the rebound in the first quarter was stronger than most people expected. What we're seeing, though, as we push into the second half of the year, is that rebound really didn't have legs. And very quickly, the story on China swung back to all of those significant structural problems. High debt, massive overcapacity in the real estate sector, growing tensions in relations with the United States, demographic drag. And these factors are dragging on growth, and they're also, as you know, dragging on prices. So in addition to all of those structural problems, China now battling with deflation as well.
Also, consumer spending not being quite as strong as economists were anticipating. Why is that?
So I think when you think about the household consumption story, there's a couple of significant challenges. So the first challenge is, well, when the economy is not doing very well, then households don't have big earnings growth, they don't have confidence in their future earnings, and that weighs on their consumption. You've probably seen there's 20% youth unemployment in China right now. If young people are worried about being unemployed, they're not going to be hitting the shops. They're not going to be spending on Taobao. The second big problem is that China's households have a lot of their wealth tied up in real estate. And when real estate prices were rising, as they did for much of the last 20 years, well, households felt richer. They wanted to go and spend some of that wealth. Now, huge uncertainty about the real estate sector. Prices in some second-tier cities already heading down. That's a blow to household wealth. Means they're less likely to spend.
Hey, Tom, some of these headwinds you're highlighting here, they seem pretty long-term entrenched, not something easily fixed. What, in fact, can the government do, and will the government do?
So we've already seen the government starting to shift policy. We've seen mini rate cut by the PBOC. We've seen the PBOC, China Central Bank, also encouraging the commercial banks to guide mortgage rates lower. That's meant to give a bit more juice to the real estate sector. We've heard the government talk about the importance of boosting consumption. So far, though, whilst there's been a sort of a steady drumbeat of pro-growth policy announcements, it's really not adding up to the size of stimulus, which I think markets are looking for to turn the short-term narrative on China around.
China is the world's, as you know, second largest economy behind the United States. How much of an issue with this slowing growth could it have more globally when you have the U.S. seeing, obviously, when you think about these inflation numbers, we're getting another reading tomorrow with CPI, but improving?
Yeah, so if we come back to the beginning of the year, there was a fear that a surging Chinese recovery will be great news for China, but by juicing commodity prices, by pushing up prices for oil and soft commodities like soybeans, it could give extra legs to the global inflation story. And that potentially could keep the Fed and the ECB and the Bank of England hiking for longer than they would otherwise have had to do. Well, here we are at the start of August, and the Chinese economy is pretty clearly run out of steam, and the stimulus so far has been not entirely missing in action, but still not adequate to the task. What that means is that impulse to global commodity prices, if anything, is in the other direction. So China isn't making the Fed's job harder by adding to global inflation. If anything, it's making it a little bit easier by subtracting from global inflation.
Do you think that investors in the U.S. are too optimistic about a soft landing and maybe not thinking about some of the issues that are potentially going on in China and how that could obviously affect, like you were talking about, the Fed's interest rate path?
So that's a really good question. I mean, I think there's just a lot of optimism about the U.S. right now, and clearly a bunch of the recent data sort of supports that soft landing narrative. Inflation's been coming down. Labor markets have remained remarkably robust. At the same time, if we think about some of the dynamics in the United States, if we think about what's happening with credit growth and banks' willingness to make loans, if we think about the amount of distress amongst household borrowers, there are some early indicators supporting, continuing to support a hard landing narrative here. And then if we think more broadly, if we think around the world, well, China's growth slowing is giving the Fed a bit of an assist on controlling inflation, but a slumping Chinese economy is clearly not good news for global growth.
Hey, Tom, over the last several years, the Chinese government really cracked down on some of the tech companies, the leading technology companies in China that had listed their shares in the West, costing a lot of investors, including Western investors, a lot of money in losses. Is there any sense that crackdown upon some of the big tech companies in China is contributing to maybe a softer than expected kind of reopening?
Yeah, so I think the investors in the West didn't get the story on China's tech crackdown quite right. I think the view on Wall Street was, this is Xi Jinping against the entrepreneurs. This is the Communist Party against the markets. I think, in fact, what China was trying to do was wrestle with some of the big problems which governments in the US and Europe wrestle with as well. They were wrestling with the problem of excess power for tech monopolies, wrestling with the problem of what to do in an information economy where big tech companies have so much access to data on everyone's lives. They did that in a way which hammered the share price for these companies, but that wasn't the objective, right? They were trying to deal with these deeper social problems. Still, that added to the sense of malaise in China's economy, and is also an area where China's policymakers have now pivoted, right? So we've seen Li Qiang, China's premier, and other senior leaders out over the last few weeks saying, you know what, we get it. We understand that these big tech companies are drivers of growth, drivers of productivity, drivers of jobs. And whilst we don't want to let them run riot, we're not going to let them gouge the rest of the economy with their monopoly power. We do want them to succeed. So that's part of the policy pivot. Let's see in the next few weeks if that starts to gain traction.
What are your forecasts for China's GDP growth for this year?
So it's funny, if you look at the forecast for growth this year is really remarkably, the headline numbers remarkably robust, right? We still think that China's going to grow above 5% this year, and that's pretty much the consensus. Unfortunately, the reason for that 5% growth is not because China's got robust momentum, it's just because 2022 was so disastrous, right? In 2022, we had Shanghai being locked down, we had other big parts of the country being locked down. COVID was still a really big drag on activity. When those controls were removed at the end of 2022, we had activity surging back.
Yep.
What that means is we have the sort of artificial impression of very strong growth this year. In fact, it's just the base effect from those COVID lockdowns last year. The reality is much more sluggish.
Tom, thanks so much for giving us some of your time. We really appreciate getting your perspective. We know you lived and worked in Beijing for many years, so you have a unique person on the ground type of perspective. Tom Orlik, he's a chief economist for Bloomberg Economics, joining us via Zoom from Washington, D.C. Again, the weaker economy in China, probably not what the markets were anticipating coming into the year.
And what that means potentially for the Fed. We
Yep.
do think they are close to being done with their tightening campaign.
Yep, very interesting. S&P 500 off 0.1% this morning. Right now, let's get world and national news. We'll go down to Washington, D.C., and Amy Marsh has got that for us.
All right, thank you, Paul. Getting word at this hour, Senator Dianne Feinstein was briefly hospitalized last night after a fall in her San Francisco home. That's according to the San Francisco Chronicle. U.S. and Saudi Arabia have agreed on an outline for a deal for Saudi Arabia to recognize Israel in exchange for some security guarantees. The Wall Street Journal reports U.S. officials are cautiously optimistic they can hammer out details within the next year. Voters in Ohio have rejected a measure that's being seen as a test over abortion rights.
The proposition known as Issue 1 would have made it harder to pass constitutional changes. It would have mandated a supermajority, 60%, where it is now a simple majority. Now, this was put on the ballot in an effort to short-circuit a proposition on the November ballot to change the Constitution to codify abortion rights. Abortion, of course, has been a state-by-state issue since the Supreme Court's Roe v. Wade ruling. The vote margin, wide. The initiative failing 56 to 43%. I'm Ed Baxter, Bloomberg Radio.
Former NYPD Commissioner Bernard Kerik has been interviewed by January 6th prosecutors.
Kerik is a close ally of Trump lawyer Rudy Giuliani, the former mayor of New York. Several media outlets say prosecutors asked Kerik about Trump's fundraising efforts and questions about fraud in the 2020 election. Kerik was said to sit down for a voluntary interview Monday. According to Kerik's attorney, the former commissioner told prosecutors that Giuliani's team looking into the allegations of fraud received no money from the Save America PAC. Save America was one of the chief groups assigned to hunt down evidence that the election had been marred by cheating. In New York, Michael Marr, Bloomberg Radio.
And the judge overseeing the election interference case has scheduled a hearing for this Friday in Washington. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash ahead of the release of the Consumer Price Index tomorrow morning. A lot of investors just sitting on the sidelines right now. You have 8 of the 11 major industry groups in the S&P 500. They are higher. Best performing sector, that belongs to energy, information technology. Right now, that's the biggest drag, and that's where you're going to find NVIDIA down 3% in today's trading. Meantime, Larry Adam, he's the chief investment officer at Raymond James, says the S&P 500, that's going to be hard-pressed to set a new record anytime soon.
12 months from now, June of next year, we think the S&P 500 is up at about 4,600. You know, coming into this year, we were much more optimistic than most. We're a little bit more cautious. Again, once we get that pullback, you know, then all of a sudden there's upside in that. And I think, by the way, people have to understand that volatility is part of the fabric of the market. So I actually think that that's a positive.
Verizon Communications says they're raising prices on some of their existing wireless plans. They're trying to boost revenue and offset slumping subscriber growth. That starts with the September bills. S&P 500, 4 points lower. The Dow Jones Industrial Average up 16. NASDAQ 100, 82 points lower. That's actually down 0.5% right now. Another indication of the downfall of modern society. 10,000 people have signed up to legally change their name to Subway as part of a promotion to get free subs for life.
Wow,
Subway is naming the winner later this month. There's got to be an easier way.
I'm a big fan of Subway.
Yeah, but you're going to change your name?
No, probably not.
Good Lord. Anyway, that is your Bloomberg Business Flash. We check the markets all day long right here on Bloomberg Radio. I'm John Subway.
Jess Subway, Paul Subway, here in the Bloomberg Interactive Brokers studio. Paul, I know it feels like the majority of earnings season is over since we've had close to 90% of the market cap of the S&P 500 reporting, but we still have a number of big names. We have Disney, as you know, after the closing bell today. We still have Walmart, other retailers coming up in the next few weeks. Also, NVIDIA, the last of the Magnificent Seven, on the 23rd, the day before Jackson Hole starts. So I want to get straight to our next guest, Kara Murphy, CIO at Kestra Investment Management, who I hear is also from my home state of Texas, or is based there at least.
She's in Austin, Texas. Now, there's a school of higher learning there, as I recall.
Yes, definitely. I mean, that's where that other school, rival school, went. I, of course, was College Station, Texas, for Texas A&M. But, Kara, I want to get your thoughts here as we've gotten through the majority of earnings season. If you look at the contraction here, around 6.7% overall for the latest growth in the S&P 500, those preseason estimates for basically forecasting a decline of about 9%, so not as bad as feared, but this still is the biggest contraction that we've seen since 2020. What's your takeaway here, and do you think the majority of the pain could potentially be passed here for these corporate companies?
Well, it's interesting because when you go back a year ago, if you recall, expectations then were that earnings in 2023 would be up 9%. So the fact that we're down about 7% in the second quarter is quite a move from where we were just 12 months ago. And, you know, looking at estimates right now, it shows a pretty swift rebound in the second half of the year in terms of what companies can earn. So we think expectations for the second half of the year are still a bit optimistic, but we do think second quarter will probably mark the bottom of corporate earnings. And as you said, like, you know, the drop isn't as bad as feared at some point in time, but it is consistent with a mild recession. So, you know, I would call the recession talk earlier this year as the recession that never was in some ways. But there are a lot of areas of the economy that actually did sort of experience a recession-like retreat. And I would say that the earnings downside that we've seen in the second quarter has been consistent with a small slowdown in the economy.
All right, Kara, it'll come as no surprise to you that neither John Tucker nor myself were overweight the big seven, the Magnificent Seven stocks that have really powered this rally year to date. That said, where do we go now if we feel like, maybe those stocks, I've missed that run. Where do I go now?
Well, don't worry. You aren't the only people who are not overweight the Magnificent Seven. I mean, it was quite a turnaround. And, you know, a lot of folks initially looking at how concentrated the market was in the first half of the year were saying, okay, that, you know, that's the sign of an unhealthy market. Market's going to turn down. And when we looked at previous experiences, when you had very concentrated markets, what we found is that actually the overall indexes continue to have pretty solid performance. It's just the leaders tend to shift. And so, mid caps, small caps, other sectors, and we've started to see that. And even, from the end of May, Russell 2000 has actually outperformed the NASDAQ. So this has subtly been happening kind of under the hood. And we think that's the sign of a healthy market, seeing that performance really broaden out.
What types of stocks or sectors are you staying away from and you don't want to advise your clients to buy at this point?
So certainly the Magnificent Seven, we wouldn't really chase these names right here. We don't think that they're necessarily shorts, but there's a lot of very lofty expectations baked into some of these names.
And is that more just near term, not maybe more of like a shorter term outlook, not necessarily like say a longer term outlook if you're saving for retirement?
I do think so. So I think that kind of overactive expectations in some of those names is a near-term issue. And we've kind of seen that through the earnings season, where some of these names have gotten, their earnings have come in okay, but the stocks themselves have gotten punished. So that's telling us that, there was a lot of sort of excess excitement in there. But as you point out, if you're like saving for retirement, all this stuff is going to be a blip in the rearview mirror. There, you just want to be exposed to stocks in the general asset class and kind of ride that wave.
Industrial stocks, which have been trading around records here, especially when you think of old school Dow theory and that kind of adage on Wall Street. When you're looking at industrials, also materials really holding up well. What do you think this tells us about the direction of where the economy's headed? Because people are concerned about when we're talking about China and the slowdown that we're seeing there, what that can mean more globally and for the economy, particularly in the U.S.
So I think industrials in particular is a really interesting area because as you think about, as I mentioned, the recession that never was, when we look at manufacturing indicators, it suggests that the manufacturing sector actually did experience a pretty significant slowdown, both when we look at prices, ISM surveys, industrial production. So that area of the economy has already sort of experienced a pretty serious contraction. And then as we look at valuations within the industrial sector, those are among the most attractive relative to history. So that tells us expectations are pretty low. And now we're starting to see some bottoming out in some of the PMI indicators. So we think that there are some interesting areas where, that part of the economy has taken a lot of the pain, expectations are low and can really see some upside moving forward. Lack of demand coming from China is a risk, but we've had a lack of demand for quite a while. So if we start to see some stabilization in the developed world, I think that'll be enough to really sustain that area.
Hey, Kara, what did you make of the Fitch downgrade of U.S. credit last week? Did that mean anything to you, or is it just kind of old news and kind of rear view mirror type thing?
Yeah, so I think my very expert opinion would be wah, wah.
Yep.
So, and I very much respect Fitch's research and work and whatnot, but everything that they pointed to were things that have been true for a very long time that we've known and been aware of. So there was nothing really incremental in that. And the way that debt markets work, you're not going to have forced selling because of the downgrade. So, I think it highlighted issues that we're going to have to contend with and are not going away anytime soon, but it wasn't new news.
One thing I wanted to follow up with, we only have about 45 seconds left, but to follow on that, we did see bank shares in particular falling broadly earlier this week, just after Moody's had downgraded the credit rating on several banks. When you're looking at that particular firm, how much of that is a concern when you're looking at financials?
I actually think that downgrade is a little bit more pertinent to the overall economy than the Fitch downgrade because credit conditions have already been tightening significantly. This puts more of a headwind there, and that really makes credit less available and becomes a headwind for the overall economy.
All right, Kara, thank you so much for joining us. We always appreciate getting your perspective all the way from Austin, Texas.
That's
Kara
right.
Murphy, CIO, Kestra Investment Management. How far is Austin from College Station?
Only about an hour and a half.
Oh, okay.
I used to make the drive off to visit my friends in Austin. Yeah,
All right.
so not that far at all.
All right, but so a great rivalry, right?
Oh, huge. And we're supposed to, the football game is 2024 for Thanksgiving is going to restart again. That used to be the huge game, and then we haven't done it in probably a little over a decade. So
okay, cool.
Stay tuned.
Good. Excellent stuff. S&P 500 off about 0.1%. The Dow unched on the day. NASDAQ off about 0.6%. We're going to have more coming up. This is Bloomberg. go to Steve Rappaport right now and get some company news.
Paul, WeWork's Wall Street woes continue with shares plunging more than 36%. Bloomberg's Abigail Doolittle has more.
This company was founded back in 2010 on the idea that they would lease big areas of office space, then rent them out to the smaller player that wanted to have a shingle. They expanded in a huge way. Well, now, yesterday, they talked about the idea that they have substantial doubts about whether or not they will be able to stay in business. It was an expansive trajectory, too. In 2019, they were actually the biggest leaser of office space in New York and London. They occupied millions of square feet, not just in New York and London, actually, but in dozens of countries.
Thanks, Abigail. Walt Disney's ESPN has signed a long-term exclusive partnership for sports betting with regional casino operator Penn Entertainment. Bloomberg's Charlie Pellet reports.
Penn will have a 10-year exclusive right to use the ESPN bet name for sports betting in the U.S. Penn will rebrand its Barstool Sportsbook with the ESPN name beginning this fall. Meanwhile, Penn says it is selling all of its Barstool Sports subsidiary to Dave Portnoy, who founded the sports and pop culture media company in exchange for a non-compete and other agreements. Penn also has the right to get half of the proceeds received by Portnoy in any subsequent sale of Barstool.
Thanks, Charlie. Disney stock is up less than 0.5%. And Carvana has raised its profit outlook as the used car dealer said momentum from an early turnaround is carrying into the third quarter. Shares of Carvana currently down more than 1.5%. I'm Steve Rappaport, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Jess Benton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Not much moving with the indexes today. Lots of economic data coming up tomorrow, and on Friday we'll get the CPI and the PPI. Key measures for the Federal Reserve and its decision-making process. Looking at the yields right here, the 10-year Treasury just off about 1 basis point here, sitting right at 4%. The 2 years at 4.77%. We're still seeing a move higher in those energy prices. WTI crude oil up 1.5% today, $84.18. So again, remember just back about 6 weeks ago, WTI crude oil was just about $67, $68. So a big move higher in oil, presumably on the tightening supply out there. Right now, let's head down to Washington, D.C. We'll get world and national news with, who is it? Let's do Amy Morris today.
All right, thanks, Paul. Wildfires in Hawaii are burning multiple buildings, forcing people in one popular tourist town to flee into the ocean. Acting Governor Sylvia Lucas issued an emergency proclamation for the island of Maui. Mayor Richard Bisson says the biggest complication right now is the wind.
It's prevented us from having helicopters assist in putting out the fires just because of the dangerous winds.
The National Guard in Hawaii has been activated to help with evacuations. The head of the United Auto Workers flatly rejected a proposed contract from automaker Stellantis as the deadline for a new agreement approaches. UAW President Shawn Fain slammed terms of the deal, including cuts to health care coverage, fewer vacation days for new workers, and lower employer contributions to retirement plans.
Stellantis' proposals are a slap in the face. They're an insult to our members' hard work over the last 4 years.
UAW President Shawn Fain, in a Facebook Live interview, tossed a copy of the contract into a trash can, saying, quote, "That's where it belongs." More Americans are dipping into their 401k accounts because of financial distress. That's according to the Bank of America. The number of those who did so during the second quarter spiked from the same time last year by 36%. California Senator Dianne Feinstein was hospitalized last night after she fell in her San Francisco home yesterday. The senator's office says she's home now. They call it a minor fall. This comes as the 90-year-old senator was dealing with health issues over the past year. And it turns out you might not need to walk 10,000 steps every day to lower the risk of heart disease. A new study from Johns Hopkins University looked at 200,000 people who were counting their steps, and researchers say it looks like you maybe need 4,000 per day. That would be a good target. Researchers say once you hit that 4,000 step mark per day, your risk of dying prematurely from any cause goes way down. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Jess.
Amy, I thought it was 10,000 steps. That's what I was told. You're saying 4?
Yeah, right. No, that's what they're saying.
Okay.
They've studied and looked at whether it should be 10,000 or more. And they were like, wow, golly whiz, only 4,000.
Oh, man. All right, so I'm
sit
in
down
good
and have a
shape
little
then.
something to drink and watch a little TV. And
All right, very good. Well, I got the little step thing on the phone. I'm doing that. All right, Amy Morris, thank you so much. We appreciate it. John, you know how portfolio managers and analysts will come into this studio and they'll talk up their book? You know, hey, I think you should buy this stock because he's on.
They're all talking up, all of them.
Turns out reporters do that as well. You know, Jess
Yes,
Benton's
we
always
should.
suggesting
Say
we
it's
talk
not
about
so.
one of her columns, and she writes a lot of stuff for Bloomberg News.
I mean, I'm here.
Energy stocks. What do you got for us, Jessica?
So I did this story with one of our star reporters, Jeffrey Morgan, who is based in Canada. He covers energy for us, but we were taking a look at what's happening when it comes to ETFs and exchange-traded products. So if you look at energy specifically, and this is more when you're looking at the 80 U.S.-listed exchange-traded products that are tracking the industry in the United States, more than actually close to $11.5 billion in outflows in energy. So if you combine all the different sectors, it's more than all of them. So the kind of question is, and Strategic Securities, Todd Stone over there is questioning whether we've hit that inflection point and basically the contrarian zone. Because if you go through mid-May, just the S&P 500's energy sector had been the worst performer, down 10% year to date. If you look at it today, it actually is positive on the year, up more than 1%. This does come, if you're thinking underneath the hood for the surface for the S&P 500 a day, looks like it's going nowhere, but the energy sector is up more than 1.5%. So obviously that correlation with oil prices, Paul.
Boy, there was a time when energy was huge in the S&P. Then there was a long time where it was like 4 or 5% of the S&P.
Right.
Now we talk a lot about energy. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we got a lot of good stuff. It looks like Disney, they're reporting the earnings after the close, and they also are doing a deal getting into the sports betting business with Penn Gaming. So we're going to roundtable this thing. Geetha Ranganathan, she covers the media industry, including Disney. And Brian Egger, he is our gaming analyst, one of the top gaming analysts on Wall Street. They're going to join us both, and we'll kind of hash out this deal. What's Disney doing? And what's going on in the sports betting business? So that'll be a good deal. Phil Palumbo, CEO and founder of Palumbo Wealth Management, joins us. He will give us his market call, and as always, a clear call with conviction. But first, let's go to John Tucker and get a Bloomberg Business Flash.
All right, thanks, Paul. The major stock average is lower to little changed right now. NVIDIA, Apple, Broadcom, they're lower. They're weighing on the tech-heavy NASDAQ 100 right now. In the second quarter earnings, they continue to roll out. Carvana advancing after raising its profit outlook. Lyft, that's falling. The company reporting the slowest revenue growth in a couple of years. So where should investors be looking at this point? We put that question earlier to Darryl Cronk at Wells Fargo.
You look at healthcare, materials, and probably a combination of energy and industrials. All have greater earnings contribution today than their market cap, which is not true of discretionary and technology. So you look where you're going to get the best earnings protection relative to valuation.
And you're going to be taking a deeper dive into this, but Penn Entertainment shares right now, they were soaring 14% after the long-term partnership with Disney's ESPN was announced. S&P 500, 14 points lower. That is down 0.3% right now, 44.85. Dow Jones Industrial Average, 32 points. That's down about 0.1%. The NASDAQ 100, that's leading the losses, 136 points lower, down about 0.9%. Here's another one that I had to look up. Get ready for Megan Fox, the poet. The debut poetry collection by the actress titled Pretty Boys Are Poisonous, set for release in November. A division of Simon & Schuster will publish the collection.
Simon & Schuster just were
KKR.
sold. Just sold, that's right. Paramount sold
This is
them
having
for KKR.
absolutely no impact on shares of KKR.
Imagine that.
Or Paramount.
JT.
$1.62 billion for KKR.
I'm trying to stay on the hip and
I
on
know.
top of this.
Yeah, Katy Perry.
Okay.
Katy Perry, hip. John Tucker, thank you so much. We appreciate it. Jess Met and Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're also streaming on YouTube, so just head over there if you want to see the video and just search Bloomberg Global News. Let's get a sense of what's happening with these markets here. The index is a little bit in the red, not a whole lot going, but Carmen Reineke, she covers the markets for us. The pride of Vassar College.
Yes.
Now, Vassar College is like an awesome school.
It is.
I couldn't even think about getting in there, but then again, it's in Poughkeepsie. So that's a little, what was it like Poughkeepsie?
You know, it was nice. You got to take the Metro North up from the city, so really lovely ride there on the Hudson.
All right.
Nice.
Not so bad.
Yeah, it's a great school.
Looks beautiful.
Unbelievable. All right, Carmen, what are you looking at in the markets here?
Yeah, so one of the stocks that we're looking that's moving this morning is Penn Entertainment, ticker PENN. Shares are up as much as 18%. It's the biggest intraday jump since 2020. They announced a long-term exclusive partnership with Disney's ESPN. Obviously, this is going to be a big deal for online sports betting. It also, said it sold Barstool Sports, I think, back to David Portnoy,
who I follow on Twitter, and he's saying I think the reporting was he sold it back in a couple of years ago at $500 million. He's saying he bought it back on pennies on the dollar. No idea what any of that means, but anyway, he's kind of back.
Right, and so, stocks up on that. It also had solid second quarter results, so that's a good one there. Roblox, in the other direction, is down as much as 21%, ticker RBLX. Second quarter earning results missed estimates. The company also said that people were spending less time playing games, so Not looking so good for Roblox. That's a big part of their business. Lyft shares are also down. It's ticker LYFT, as much as 10% today. The ride-hailing company reported slowest revenue growth in 2 years. So that's really overshadowed the third quarter revenue forecast, which is above estimates. And this is interesting because we obviously compare, Lyft and Uber.
Right.
Uber is looking a little bit better.
Yeah, and they just had their results last week, and they reported their first ever operating profit. But unfortunately, the pace of growth has decelerated from those pandemic highs.
Exactly.
But they've been able to have more of this sort of margin type business, right? When you're thinking about Uber Eats and expanding, whereas Lyft, you had David Risher come in as CEO, trying to really turn it around, but they don't have that kind of exposure that Uber obviously does.
It's just in a completely different place.
Yeah, it's amazing. When these things came public, I said, kind of the same kind of business. I guess Uber's got the eats and everything, but look at the market cap differential today. I mean,
it's
a
massive.
tale of two cities. Lyft has got a market cap of 4.3 billion. Okay, Uber's got a market cap of 91 billion. I just never saw that kind of divergence when these two companies came public. I kind of felt like they were, almost interchangeable. But the pandemic changed that and it highlighted the value of the Eats business.
Exactly.
And Lyft doesn't have that.
Carmen also actually writes our Tech Watch column. We have a few different reporters on that. I know you were looking at Palantir's recent results and how obviously the AI hype did not deliver the strong outlook that people were expecting. What are you seeing there when it comes to that stock that has been on such a tear, right?
Yeah, I think it's a really good early example of how investors really need to see the proof in these AI darlings. As you said, Palantir had this huge run-up sort of from May into its earnings on these hopes that, it was going to be able to show that it had a pathway to revenue for these AI things and sort of outside of its government contracts, which I think is a big part of its business. And that, that didn't come to fruition in its earnings. And so the stock got, really punished for that. And I think investors are really looking for that now in the early waves of AI. They want to see, okay, can this become profitable? Do you have a way to drive revenue with this technology in the near term? To, keep buying, especially because these stocks maybe they're expensive compared to this year, right? Maybe not historically, but they're a little bit of a premium right now.
Right. That's ticker symbol PLTR. That stock up, Paul, over 140% still year to date. And then we also have NVIDIA reporting on August 23rd.
And that kind of brings up, looking at what happened to Palantir kind of brings up what I think may be a risk for NVIDIA, which is, boy, if you don't put up a blowout number.
Like even just meeting.
Yes, even if just meeting, that might not be enough given, how much these stocks have run. So the built-in expectations are huge. And at least in the short term, you got to be prepared, I would think, for volatility coming up.
100%. And especially NVIDIA is coming off of that huge quarter at its last report. So people are definitely watching to see what's going to happen there. And I think we've seen just overall this earnings season, sometimes a meet isn't enough. Sometimes even a beat isn't enough. You really have to go above and beyond for investors to continue to want to buy into your
if you look at the Bloomberg intelligence data, Paul, if you are beating on EPS and sales in aggregate, they're outperforming the S&P 500 by about 1%, but that's below the 6-year average, which is around 1.4%. So still, even beating is not seeing quite the wins there when it comes to how that's translating into stock prices.
All right, one more name I want to get to because I didn't even think it was a thing anymore. WeWork.
Yes.
So, WeWork, I didn't even know it was still a publicly traded company, but apparently it is. But it's trading at 13 cents right now, and it's down 37% today. So what's the story there for our friends?
Yeah. So I agree with you. This is one we haven't heard in a while. Obviously, it was a really big deal a few years ago. So it's this is a record plunge, 33%, nearing an all-time low or at an all-time low. The company said Tuesday it has substantial doubt about its ability to continue operations. And so this is one that was really, really hit by the pandemic. People just not coming back and using office space. And it's having, an issue just keeping things going with people canceling their contracts and just not using these buildings.
Yep. All right. Just amazing. Yeah. That's what a ride that stock had just from the beginning to kind of where we are here. Carmen Reinecke, thanks so much for joining us. Carmen covers all the markets, star reporter on the markets team. All right. One of the big news items over the last 24 hours was in the gaming space and involving one of our favorite companies, the Walt Disney Company, doing a deal with Penn Entertainment and kind of getting into the sports betting business all in. It's amazing how that business has changed over the last 3 or 4 years. Let's roundtable it with a couple of smart people that we happen to know. Geetha Ranganathan, she covers the media industry, including the Walt Disney Company for Bloomberg Intelligence. She joins us via Zoom. And Brian Egger, he covers all the gaming stocks. He's been covering the gaming stocks for decades. On Wall Street, starting back in DLJ, maybe even somewhere before back in the day. We'll get a sense of what it means for the gaming space. He joins us here in our Bloomberg Interactive Broker studio. Geetha, let's start with you here. Is it surprising to you that Disney, Mickey Mouse, wholesome Walt Disney Company is getting into the sports betting business?
Yeah, I mean, this has kind of been this question always, Paul. Obviously Bob Iger and the Disney management team have always kind of wanted to keep that squeaky clean, family-friendly image and didn't really want to get into sports betting directly. Brian Egger has told me so many times it's very difficult. The sports betting business, owning a sports book directly is very difficult. It's fraught with a lot of operational, a lot of regulatory challenges. And so this kind of gives them nice exposure. So it kind of, they're getting that $1.5 billion in cash, the $500 million in stock options. So it gives them, a good exposure without getting directly involved. And it kind of tells us that ESPN, the brand, definitely does have value. That is a question that some of the investors did have, and this kind of puts to rest any of those fears.
Brian, I want to bring you into this conversation. When you're looking at this deal here, how does this translate into what you think shareholders will want to see from this moving forward?
So the pre-existing Barstool Sportsbook deal never really garnered more than a mid-single-digit share in the 16 states where Barstool Sportsbook had been active. This has the potential to be a much larger generating deal. Now, of course, it will involve Penn putting up basically $1.5 billion to $2 billion in commitments for marketing and other things, basically to get that and rebrand all those Barstool Sportsbooks as ESPN. Much more promising, and they are thinking about long-term EBITDA potential annually of $500 million to $1 billion. We're going to still take some time to work the numbers on that, but that's really where the opportunity is because ESPN is such a coveted brand. Although I should mention other media companies that have endeavored to team up with sportsbooks have had a tough time breaking through and taking on the likes of DraftKings and FanDuel.
Why has that been such a challenge?
I think it's just a fairly competitive business with a lot of upfront customer acquisition costs, and the more native operators, you have DraftKings and FanDuel, which have been daily fantasy sports operators. You have the likes of BetMGM and Caesars, which were closely affiliated with big name brand casino companies. So for that reason, it's a pretty crowded landscape, and it has not been as easy as one might think for even a well-regarded media outfit to break into this space.
So, Geetha, you highlighted an interesting point here that it just getting this deal done with Penn kind of highlights there is still a lot of value associated with the ESPN brand. But the reality is it's not the profit engine that it used to be for the Walt Disney Company. Walt Disney reports earnings after the close today. I think one of the many topics you and the analysts and investors will want to discuss with management is the future of ESPN. What's the current thinking here about the future of ESPN?
Yeah, that is, obviously going to be front and center, Paul. So ESPN, it's been a real roller coaster here, right? So this used to bring in, as you pointed out, about 35% of the whole operating profits of Disney. But for the past few years, they've kind of had this double whammy, right? So they do generate about $13 billion in revenue, $13 to $14 billion in revenue. But cord cutting is kind of pressuring that top line. And then you have rising sports costs, so about $9.5 billion in sports rights fees every year. So again, that's growing and that's pressuring the bottom line. So they're kind of pressured on both sides there. And the writing on the wall is clear, and Bob Iger has acknowledged this many times. He knows that he has to take ESPN over the top. They have to go all in as far as streaming is concerned. So it's not a question of when, it's not a question of if, it's a question of when. But again, there are so many different things that need to be kind of ironed out because there's a new deal that's coming up with the NBA. There are existing TV deals in place. So again, it's not going to be easy, but we'll have to wait and see what Bob Iger says.
And speaking of how the NBA rights is the next big renewal that is going to happen, the current deal, like you were talking about, ESPN and Turner, does end after the 2024 and 2025 season. What do you think most likely would come out of that?
Yeah, so there's been, again, a lot of interest from many parties, not just the media owners, not just Disney and Turner. NBC wants to get involved. And then, of course, you have the perennial question with the tech giants. Will Amazon, Apple, and Google make this big play? We know Amazon has not been shy about getting into the sports arena. They already have Thursday Night Football. Again, Apple is dabbling a little bit with MLS. So it's going to be interesting to see. And Google, of course, has that big YouTube Sunday ticket deal. So they've all already made bets in the sports rights field. So it's going to be interesting to see whether they want to do the same thing with NBA. Now, NBA is a brand that travels globally. It also appeals to young males, which is really a coveted audience when it comes to advertising. So that those deals negotiations are going to be really, really interesting to watch.
Hey, Brian, this deal with the Walt Disney Company, to me, highlights just the growth and the attractiveness of sports betting. Where are we in the evolution of sports betting? You said 13 states have it?
It's more like 35 states with some form of it, and over 24 that have online sports betting, which is by far the biggest contributor. So it's rapidly growing since.
And so how does it change the economics of Vegas, the sports books in Vegas? I like to just plop myself down in a sports book at Caesars, sit there for a day and just watch sports. What's going on there?
No, yeah, I think the brick and mortar sports book, historically sports betting has only been about 2% of gaming revenue. That's very different than online, which is really not as big in Nevada. It's very big in states like New York and New Jersey. And that's really where we've seen this penetration opportunities, the online part of sports betting.
So so the growth of that business, I mean, it's a long-term growth story, right?
It's longer term. I mean, if to get to the $500 million to $1 billion in long-term annualized EBITDA potential they see from this deal, it will take some time to get there. There'll be some upfront customer acquisition, marketing costs, a lot of money going through Disney and through ESPN. But there is enormous potential after getting to that additional upfront spend.
Hey, Geetha, we got about 30 seconds left. Will Bob Iger on the call tonight address succession plans?
I certainly hope he does. And this has been such a perennial pain point for Disney. I mean, they do have another 3.5 years with Bob Iger, so I think there is some near-term stability. But yeah, it still remains this biggest question mark for Disney.
Yeah, it's just crazy. He was doing so well with that succession planning for a while there, and then it all fell apart, and nobody really knows why, other than he likes a job and he doesn't want to give it up. Simple as that. So if you're looking to be a successor, good luck. Geetha Ranganathan and Brian Egger, they cover the media, they cover the gaming spaces, respectively, for Bloomberg Intelligence, two of the smartest voices out there on their respective industries. And if you want to get access to their research, it's really simple. If you've got a Bloomberg terminal, BI-GO on the terminal, that'll take you to Bloomberg Intelligence. We cover 1,200 companies, 2,000 companies, 120 industries, 400 analysts across the globe, and they've got it covered soup to nuts. So Brian and Geetha bringing us up to date on Disney and Penn Gaming. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, that new contract for UPS drivers spurs interest from potential job applicants. Bloomberg's Jeff Bellinger reports.
Steve, the online jobs board Indeed saw a more than 50% increase in searches for UPS or United Parcel Service since the union secured a 5-year, $30 billion deal for workers. That's according to data shared with Bloomberg News. UPS driver jobs near me has also been a top trending search on Google. The company agreed to boost wages for part-time workers and improve working conditions to avert a strike. Union members have yet to accept the tentative deal. The results of an ongoing ratification vote will be announced on August 22nd. Steve?
Thanks, Jeff. Shares of UPS are down less than 0.25%. Disney stock is down more than 0.5% ahead of the company reporting quarterly earnings after the bell. More on that from Bloomberg's Lisa Mateo.
Steve, the big concern for investors is about CEO Bob Iger's plans to restructure Disney's massive broadcast and cable TV operations. They'll also be looking at how many subscribers Disney added to its Hulu, ESPN Plus, and Disney Plus streaming TV services, and when the company will finally be profitable. Continued strong numbers are expected in its theme parks and cruise division. Steve?
Thanks, Lisa. Hedge funds are betting that stocks in the market's hottest sectors will cool off. According to data compiled by Hazeltree, Tesla, Gucci owner Kering, and Japanese chipmaker Advantest were the large cap stocks with the highest percentage of funds shorting them last month in their respective regions. Investors are worried that the boom in electric vehicles, luxury goods, and AI might not last long. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with crude oil prices. Oil right now climbing to the highest in almost 9 months. So there's concern possible escalation of the conflict between Ukraine and Russia could choke off more supplies. In the S&P 500 right now, energy, the best performing major industry group. The major stock average is all lower, with technology proving to be the biggest drag right now. For instance, you have NVIDIA shares. They are down right now over 5%. Apple shares, they're down over 1%. Then Broadcom down close to 4%. And then investors are looking at the next major data point. We're going to get that tomorrow morning. The Consumer Price Index will be out. Right now, the S&P 500, 28 points lower. That's down 0.6%. We're at 4470 on the index. The Dow Jones Industrial Average, 147 points lower. That's down 0.4%. And the NASDAQ 100, leading the losses for the index, is 194 points lower. That is down right now 1.25%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Jess.
Thank you, John Tucker. We appreciate it, Jess Mitten and Paul Sweeney here in the Bloomberg Interactive Broker Studio. And I want to get straight to our next guest, Odetta Kushi, Deputy Chief Economist at First American. Odetta, I have to get your thoughts because this morning it was lighter on the eco calendar, but we did get data on mortgage applications. They did fall another 3% last week. So this is the third consecutive week with the 30-year fixed mortgage rate actually rising to the highest level since November of 2022 at over 7%. What's your takeaway from today's data and what this means for the housing market?
It's not entirely surprising to see mortgage applications come down. We're not likely to see a meaningful pickup in home sales when there's so little inventory out there for sale right now. And that's really a function of the fact that the housing market, the bulk of inventory comes from existing homeowners. And existing homeowners have locked into the pandemic record low mortgage rates. Over 90% of homeowners today have locked in mortgage rates below 6%. And as you mentioned, mention, mortgage rates today are hovering, around 7%. And so there's a financial disincentive for those existing homeowners to sell their homes, and you can't buy what's not for sale. So that lack of inventory, because of existing homeowners feeling rate locked in, is going to prevent home sales from picking up meaningfully.
Well, Odetta, I'm happy to say that I am one of the 10% of people. I have not locked into that low mortgage, but when I purchased the Jersey Shore,
the compound,
the compound down on the Jersey Shore, I have a 6% handle on my mortgage, and I thought I was a numbnut for going into that mortgage. Now I look pretty smart. So is there a rate, do you think, Odetta, where it might free up the market? I don't know if mortgage rates go back to 5% or something like that. Do you feel like there might be a rate that might start clearing this market?
I do think 5% has sort of been thrown around as a magic number, but we saw even when rates, dipped closer to 6% or around 6%, that there was more activity in the market. There's substantial demand on the sidelines, particularly from millennials that continue to age into their prime home buying years. Yep. And they're sort of just waiting for that payment to paycheck calculation to work for them. So I think even if you see rates come down from 7% to get closer to 6%, I think you'll see some pickup in the market.
Something I'm curious about, because when I think of D.R. Horton or Lennar, they have a particular demographic that they're building for it. A lot of portfolio managers I'm speaking with, they're still snapping up a lot of these home builder shares because they think because of the low inventory, these home builders are going to continue to have to build. But what about particular Americans who might not be able to afford those types of price points? What do they do? And what do you think that means for the economy if they're not able to purchase those homes?
Well, that's really the concern, is that potential first-time home buyer that's been priced out of both the existing market and the new home market. And we have seen the new home market pick up market share simply because they have the ability to offer incentives, right? They can offer price cuts or quality features on a new home. They can offer rate buy downs, something that we don't see on the existing home side. And so a lot of those potential first-time home buyers are sort of on the sidelines waiting for either prices to come down from recent peaks or mortgage rates to come down for recent peaks, or hopefully a combination of both to result in a more affordable market.
Are we in a housing recession, or how do you define a housing recession?
So the risk of what we're calling a double dip housing recession is mounting. We haven't called that double dip quite yet. We need another month's worth of data. But according to our rule-based measure, the housing recession, started in May of last year and ended in November of last year. Then, of course, we saw mortgage rates start to come down from recent highs. We saw the new home market start to rebound a little bit in the beginning of this year. But now we're back in an environment where house prices are re-accelerating and mortgage rates are climbing once more. And so those are resulting in this higher risk of a double dip housing recession.
And with CPI coming out on Thursday, when it comes to shelter and housing, that's around a third of the weighting in the CPI measure. What is your take as far as when you're looking underneath the hood for the CPI report, what you think when we're looking at rents as well as what's happening with those shelter costs and what that's going to tell us about inflation right now?
That's right. To your point, shelter is such a huge component of that overall CPI, but the way it's measured in the CPI, it's measured with a lag, about a 12-month lag. We know from real-time data that rents have started to come down from recent peaks, and so that should start to show up more and more in that shelter component of the CPI and drag that overall CPI lower.
Typically, I guess if you talk to most market participants, they feel like the Federal Reserve, if they're not done raising rates, they're close to it, but that the rates will stay sticky here. Does that kind of suggest that mortgage rates as well will stay sticky here in the 6, 7, maybe 7.5% range?
I think if the Fed provides some certainty to the market that they're done with hiking interest rates, that we'll see at least some more stability in mortgage rates. But I don't think that we'll see any substantial decline in mortgage rates until we see inflation come closer to the Fed's 2% target, or if there's a significant decline in economic activity.
I'm taking a look at the Atlanta Fed's GDP now. So their latest estimate for the current quarter and the third quarter growth is just over 4%. And then if you look at the ECFC function in the Bloomberg terminal, if you look at a quarterly basis too, this keeps getting pushed out where now in the fourth quarter, there's just a mild contraction of about 0.2%. So clearly economists don't see when you're looking at these forecasts on aggregate now that a recession is on the horizon, but it still seems as if like when you're speaking to people, there's definitely a negative tone there and still a concern. How do you view the direction of where the economy is headed?
I always come back to the consumer. In the United States, the consumer is king. 70% of economic growth is dependent on consumer spending. And so when I think about the outlook for the economy, I think, is the consumer employed? Are they feeling confident? Are they out there spending? And so far, consumer spending has been pretty resilient. Consumers are still sitting on excess savings accumulated over the pandemic, but that excess savings is dwindling. And so, estimates are showing that we can continue the current rate of saving for maybe the rest of this year, but then it starts to get a little bit hairier going into next year. And so I think consumers are still doing well in this economy. The labor market continues to remain strong. They continue to sit on excess savings that can finance spending, but that can't go on forever. We haven't miraculously figured out a way to avoid business cycles. So I think they're in a good position for now, but the future, the crystal ball gets a little hazier next year.
Aside from interest rates, mortgage rates, which obviously are a key indicator going on in the real estate market, what else do you look for in terms of the health or the weakness of the housing market?
It really is. Are consumers feeling confident? I mean, when we think about buying a home, that is typically your largest expense, is buying that first home. And so consumers need to feel confident that they will have a job, that they will be gainfully employed. And so consumer confidence, I think, is key in the housing market and the labor market, of course, making sure that consumers are employed. And so I think that would be the other factor, is income, labor market, alongside, of course, mortgage rates.
When we talk about so many of these stimulus measures in the depths of the pandemic, especially people who were able to lock in these historically low rates for so long on the mortgage side, are we underestimating the strength of the consumer when they're able to save in other places for potentially a while now, in other corners, if we were thinking about what it means on aggregate for consumer spending?
That's right. I mean, these consumers that locked into record low mortgage rates, their mortgage debt to income is very, very low. And so that's sort of a boon to spending. It means that they can spend, maybe have a little bit more in their discretionary spending. And then, of course, we often forget that in the United States, most consumers lock into 30-year fixed rate mortgages. And so their monthly mortgage payment is fixed. We have, a 66% homeownership rate. 66% of Americans have an inflation hedge. Everything else is getting more expensive in their life except their housing costs. And so maybe in other countries that have more prominent sort of variable rate mortgages, they're really feeling the effects of higher interest rates. In the United States, those who locked into 3% mortgage rates, that's sort of their inflation hedge right now on their biggest expense, monthly expense.
Odetta, thank you so much for joining us. Really appreciate getting some of your time and some of your analysis. Odetta Cushy, she is a deputy chief economist for First American. And my takeaway is she doesn't expect mortgage rates to come down anytime soon. And I was so looking forward to refinancing my six-handle mortgage.
Compound.
Yes. But she's right. I think it's all just kind of relative. I felt like when the mortgage rates were sitting around 6%, we started seeing some of the data pick up. The housing transactions were picking up.
Right.
Because people just kind of got used to the new normal, maybe. But now that they've moved again above 7%, like, now I got to get used to this now.
Yeah, now you're seeing those applications pull back. So we'll have to see whether or not a trend begins to develop further there when it comes to that data, Paul.
Yeah, I'm looking to refinance. So just, I guess it's a 2024 event, hopefully. Right now, let's head down to Washington, D.C. Get world and national news with Amy Mars.
All right, thank you, Paul. U.S. and Saudi Arabia have agreed on an outline for a deal for Saudi Arabia to recognize Israel. This is in exchange for some security concessions. The Wall Street Journal reports U.S. officials are cautiously optimistic that they can hammer out details within a year. Voters in Ohio reject a GOP-backed measure that would have made it tougher to protect abortion rights. Ohio's Republican Senate President Matt Huffman expressed his disappointment in the outcome.
There were some key folks on our side of the aisle, Republicans especially, who actively opposed this, some pretty vociferously. And then there were key Republicans who simply didn't support it, who should have been doing that also.
President Biden says democracy won. The measure in Ohio was defeated 56 to 43%. Former NYPD Commissioner Bernard Kerik has been interviewed by January 6th prosecutors. Bloomberg's Michael Barr explains.
Kerik is a close ally of Trump lawyer Rudy Giuliani, the former mayor of New York. Several media outlets say prosecutors asked Carrick about Trump's fundraising efforts and questions about fraud in the 2020 election. Carrick was said to sit down for a voluntary interview Monday. According to Carrick's attorney, the former commissioner told prosecutors that Giuliani's team looking into the allegations of fraud received no money from the Save America PAC. Save America was one of the chief groups assigned to hunt down evidence that the election had been marred by cheating. In New York, Michael Barr, Bloomberg Radio.
World Health Organization head Tedros Adhanom Ghebreyesus will not run to become the next Secretary General of the UN in New York, and instead is campaigning for a woman to fill that role. He tells Bloomberg News he already works weekends and holidays, especially during the COVID pandemic, and he wants to spend time with his family. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
hits, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Slide in some of the tech mega caps and also higher energy prices. They're weighing down on risk sentiment today. Tech-heavy NASDAQ 100, that is down right now, let's see,